Okay, welcome everybody to another Sunday session. It's Memorial Day weekend down here in the US, so a little long weekend. Happy Memorial Day, I guess, to all that celebrate. And yeah, I think it's been a interesting time here, as always. As always, I say this every single session. The oil and gas markets have kept us on our toes. I think a lot of us were expecting somewhat of an uptick here in the last few months, just with us coming into 2023, the midterm elections being finished, some of the SPR release being done, a higher demand going into Q2, and yet again we've been kind of stuck in this area, just given some of the overall broader market volatility. We're obviously seeing this debt ceiling problem that continually hampers seems like all commodities. And then the open interest in oil continues to drop. There's been some pretty interesting graphs that have been put out there that show the extent of the destocking or liquidation that's occurred. So I think really, when I come back to it, the things that I like to share are straight supply demand fundamentals. I've said this before, you cannot solve a structural bull cycle without investing in supply. And what's happened over the last 6 months is not only have people stopped investing in new projects in supply and new exploration, but actually some of the rigs in the US are now being dropped. And we're down quite a few rigs, quite a few frac fleets, and there's the actual second order impact to the supply side of things because the drawdown has lasted so long. So I'll discuss that here as we go. A couple things up front. I'm not an investment advisor, so everything I share today is my own opinion. It's my own conclusion and my own hypotheses. Please do your own due diligence on everything I share today. And please talk to your registered investment advisor if you're looking for further actual professional advice. Also, please check your risk tolerance. So oil and gas is by nature a very volatile and very risky, high risk, you can say, industry. There's a lot of factors at play, more than just investment. There is the execution risk. There is the liabilities of the actual assets that are there. You have the commodity price risk. You have the paper markets. There's a lot of things out there. So just make sure you're aware of your own risk tolerance, and then please be aware of your portfolio construction. So my portfolio that's public on my website is built for a specific future forward-looking mandate and price environment that I believe to be upcoming and is going to stay there for many, many years. So it is built for that, and it's built with a certain margin tolerance on it and significant exposure to junior oil and gas companies as well. So when you're looking at your portfolio, please check your own portfolio construction as well. I do have a mailing list now, so anybody who would like to join that, please just DM me or shoot me an email. All I send is the Zoom links. That's it. So if you feel like you're getting that anyway through my Twitter feed or my website, you don't need to be on the mailing list. It's strictly for that. I don't have any newsletters or any other subscription-based services or anything. So there's that. The Zoom is recorded, so it will be on YouTube here shortly. The Twitter space obviously will stay as it always does on the Twitter verse for 30 days, and I believe it goes away after that. So yeah, I think that's kind of the beginning of it. And a quick reminder, once again, anybody on the Twitter space that would like to join for the Zoom visuals, whitetundra.ca. If you scroll to the bottom under events, the link is there. Otherwise, the Twitter will continue for audio only. So as I mentioned, we'll begin with a brief macro portion here. So, one of the bigger things that I've been tracking has been the US rigs. So we saw a ramp up last year. Things didn't really ramp up exactly with the oil price, so there's always a lag. The highest price we saw last year was in May, June, yet the overall rig count did not hit its peak till about late October, early November. So there is a lag period there. There's also a period or a price above which rigs are going to keep getting added. So along with the lag time, depending on where the oil price is at, is going to determine the acceleration of the rig count. So we saw this steady growth throughout last year into October, November. And then once prices kind of got to that $80, $85 range, rigs already started dropping. So contrary to the popular belief that we need $70 oil for rigs to drop, or shale break evens are 55, all this stuff I see out there, the evidence is right in front of you. As soon as oil price hit 85, even $80 a barrel, rigs had already started dropping. This is November onwards. We saw that going into the new year, further collapse in rig activity. And then you see what's happened over the last 4 to 6 weeks is a further increase in the slope of the drop. So now where we are with how many months we've been here below $80 a barrel, and then some of the exhaustion that's happening with some of these private companies, you're seeing a tremendous drop in the rig count, and something that's sustaining. This is something that's caught me off guard too. There has been no period where the rig count actually flatlines for a little bit. It just continually is dropping, and now that slope has gotten bigger. Baker Hughes is about 2 months behind, roughly. The reason for that is Enverus uses satellite technology in real time, so they can track which rigs are working, whereas Baker Hughes relies on their salesmen. So the salespeople go out, they are in touch with all the rigs in the area. Whether they use Baker Hughes drilling bits or not is irrelevant. They track all the rigs. So there's a delay there between when they figure out that the rig's not working, then they relay it back to whatever the main area is, and then it comes into the rig count. So you can almost see even the rise has a 2-month delay on it compared to Enverus, and now the fall also has a 2-month delay on it. So this is oil rigs here. You can see we are well below the 2019 level, and now further dropping from there. So definitely something which is understated, I think, as this year goes on, because these are shale rigs. So shale itself, I had this on my Twitter feed a couple days ago. If I stopped drilling shale today, we would have a 45.5% decline rate in 1 year. So if US shale is producing 8 million barrels today, we would be at about 4.3 million barrels in 1 year. So it's not that dropping a rig means we're not going to grow. It means we don't even have the rigs to maintain that legacy production. And of course, shale being high decline, it can fall off in a very, very short period of time, especially if that rig count stays subdued as the year continues. So I think this is becoming a more and more of a factor as the year goes on. Definitely keep this in mind here, and something I will continue tracking, obviously, as the days and the months go on. And we look at the same graph from Rystad has been confirmed. You can see how the slope of the line has changed. So there was this growth period and then a decline period. And now there's almost like a second stage decline because of how long this sub $80 oil environment has lasted. And this is something that really is very interesting to me, because there's this narrative that, okay, oil supply is going to be at this at the end of the year, and oil demand is going to be at this at the end of the year. But this is all a dynamic system. You can't just say oil supply is going to be this, because the supply number is going to be vastly different in a $70 oil environment versus a $100 oil environment over the preceding few months. So there's definitely an impact being made here. But of course, everything takes time to play out. And it already is playing out, as I will show here in the next couple of slides. So we look at the onshore counties with active horizontal rigs. What I get from this is how many counties have the active rigs? Yes, but what it means is how many new areas are companies going into? Like a lot of companies have acreage in Midland. They got a lot of acreage in Delaware. They have acreage in the Eagle Ford. Yes, but they're all really in the main counties that have the best rock left, or that they have huge infrastructure areas, huge pipelines, in order for the companies to go and maintain production and grow production. But when we saw this number of counties go up in August, September, October, even though the rig count had not maximized at that point, it kind of told me that, okay, companies are taking a risk here. They're going to other parts of the Permian. They're going to other parts of the Eagle Ford. They're going to other parts of the Bakken. and that has gone completely collapsed. We see we're back to levels that we were in December of 2021. So it's not even back to 2022 levels. We're all the way back before the massive rig count ramp started in late 2021. Same thing for Texas and the same thing for the Permian. We've lost these 7 or 8 extra counties the companies were drilling in to kind of maintain their production and grow production. Be interesting to see how this goes on. Does it actually continue falling along with the rig count, or is there still some activity in some of the other counties as the months go on? And the same thing when we look at the actual counties in the Permian. So we see Lee County, which is by far the most productive county in the Permian, had its really, really big ramp here, and now it's down. Eddy County, probably the second best county in the Permian, is the one that's rising now. We see other ones that are in and out. Midland in particular has also come down, which is one of the most active counties in the Midland part of the Permian. And then there's certain counties like Howard County, where things have just gone really bad. The rig count in Howard County has dropped from 25 rigs to 10 rigs in the last 9 months. So any operator in this area, we can make a conclusion, is running on fringe acreage. So as the price have come down, the acreage in this Howard County doesn't make sense anymore to produce. So they have either moved the rigs to different counties like Eddy, or they've dropped the rig entirely. And this is really a way to understand where the rigs are. A well in Lee County is going to be 1.5, twice as good as a well in Howard County. So if we see rigs moving there, you could have the same number of barrels come online with a lower rig count. So there is a nuance to this. Looking at it just from the rig count is not a good way to do things. You get an overall idea. And for most investors, that is more than fine. But for the investors that are really looking to nail down this shale peak thesis, or how much shale is going to decline this year, I think looking at it from a county by county perspective, and then even an operator by operator perspective, may not be the worst thing. And it's very easy to do. It doesn't take very long. But you can definitely see certain counties have been adding rigs, certain counties have dropped rigs materially. And we see the same in other parts of the US shale complex, like the Eagle Ford has gone smashed. Scoop and Stack in Oklahoma are doing really poorly over the last 4 to 6 weeks. And really, this is where the big decline is. When we look at overall US rigs, the Permian is relatively been flat over the last 6 months. But really, in the last couple of months, we've seen a big loss in these tier 2, tier 3 parts of the US complex. So the Eagle Ford, the Scoop and Stack, and then even the Bakken looks to be losing rigs here. The North Dakota Oil Commission actually puts out a daily Williston Basin rig count. So we can track all of this, we can check it, we can verify everything just to see in real time what's happening. And then some of the smaller basins also are losing rigs, but relatively flat. Really the main decline, non-Permian, has been in the Eagle Ford and the Scoop and Stack. So, it's kind of, the way that I would think about this is, okay, if the Permian was supposed to grow X number of barrels per day, but now the Eagle Ford is dropping 10 or 15,000 barrels a month, and Scoop and Stack are going to be down 10,000 barrels a month because of this loss in rigs. Well, now the Permian has to make up for that before it can contribute to overall US production. And that's the problem we currently are in. That's the problem we were in pre-COVID even, but now it's even more of a problem because the Permian itself is getting exhausted and unable to grow organically. Okay, the next really important one that people are tracking is the Russian oil exports. So very contentious issue. You can see the trend has been flat since mid to late December. There was a growth spurt here just before the voluntary cuts kicked in. So the last 2 weeks of April, Russia really exported a lot of oil. We saw a bunch of Bloomberg articles come out about the non-committal to the cuts. And then now we see the trend is looking a lot better. So coming into May, we were back down to this what would this be, about 3.7, 3.8 million barrels a week sort of number. And then we were coming down. And now this week, I mean, Sunday is not fully complete yet. So this last bar is not fully the full week data, but we're looking at a trend that seems to be normalizing here a lot lower. And of course, because these two prints have gone taken out, the 4-week average looks a lot better now for all of these news articles that are going to be coming out about this. However, there's a lot of nuances with Russia. The seaborne export market is about 3.7, 3.8 million barrels in a country that produces north of 10 million crude plus condensate. So we're looking at a very, very small part of the market in order to make conclusions about what Russian production is doing. In my opinion, it's not the right way. However, we don't really have the data for everything in Russia, especially not in real time, in order to make any sort of conclusion. So seaborne exports is our best one. But when we look at what's happened over the last few months, so the Russian pipeline going into Germany, Hungary, and Poland has been stopped. So about 300,000 to 400,000 barrels are no longer going from pipeline into Europe. So what's going to happen to that oil? Well, it's going to now be redirected to seaborne crude exports. So even though seaborne crude exports are flat, the pipeline volumes are down 300,000 to 400,000, which were redirected to seaborne. It goes to show you why just looking at this one point makes it clear why the seaborne export data, using that to conclude the production, is not correct. The other thing is the Russian refining complex. So Russia's got a lot of refineries. They pump about 5.5 to 6 million barrels of domestic refining capacity that they use. And guess what? It's maintenance season. So during maintenance season, between February and May, we see a 400,000 to 500,000 barrel decline in the number of barrels being put, the crude throughput into refineries in Russia. So where is that oil going to end up? In seaborne crude exports for that period of time. And I think that's really the thing under the scenes, that Russia has consistently gone out and said, yes, we did cut production, but yet there's all these attacks on them that they haven't cut production when the data is clear. If your seaborne crude exports are flat, while you had 400,000 of extra of pipeline barrels now to export, and you had 400,000 barrels of oil that's not going to refineries that you can export, once again, yet your seaborne exports are flat, what is it telling you? To me, there's a clear trend here that as these Russian barrels, as the Russian refineries come back, you're going to see that crude, the seaborne export now start to fall as the months go on. Along with that, Russian internal demand has a very seasonality portion to it. So you can see this by looking at the number of flights in Russia. From January to May, mid-May, the flights are flat. And then from mid-May to mid-August, the flights double. They really ramp up there. And they have this very short period of higher demand. Obviously, Russian flights are much lower than they were pre-COVID. They're even lower than they were last year because of the activities with the Ukraine war. They're unable to go and launch the routes that they would like to. There's obviously the sanctions also going on. So the seasonal demand bump is not going to be as big, but just keep in mind, there is a seasonal demand portion of this equation as well. Russian internal demand is 3.5 to 4 million barrels a day. So this is not some chump country that's barely using any oil. There is a significant portion of it that is consumed domestically. And if the Russian internal demand goes up 300,000, 400,000, 500,000 barrels a day in the next few months, well, guess what? That also is not going to be coming up in the seaborne product exports or the difference between product imports and exports. And then one final icing on the cake, Rystad identified this about a couple of weeks ago, is that of the April barrels that were shipped out of Russia, 400,000 barrels per day came out of stocks, as in inventories. For the month of May, 200,000 barrels a day is coming out of inventories. So In addition to all the stuff around supply, demand, refining, and pipelines, we also have inventories there that Russia has been pumping out over the last 2 months. They built inventory in February. They built inventory in December, and now they're pumping that inventory out into the market now that they have the opportunity to do so. So again, a very complicated situation, making very conclusive statements on Russian production or whether the Saudis are pissed at Russia or anything like that, based on 37% of the data of overall Russian production, not a recipe for success. So there's a few things happening here, and of course, Rystad has also identified that the Druzhba pipeline, the exports are down by 300,000 barrels per day on that pipeline, and the overall exports are down 600,000 barrels per day when we look at it from a year-over-year basis. And those barrels are not coming back unless there is some sort of sanction relief or the European countries decide to import anyway. There is not going to be these pipeline exports coming back. And we can verify that because when we look at European seaborne imports, it's gone up. And there's a very easy explanation for that. The fact that you lost 600,000 barrels of oil from Russia coming in through pipeline, you still need that 600,000 barrels of oil. So you're not going to import it through seaborne routes. And you can see the year-over-year change is roughly exactly 600,000 barrels per day. And when the other pipeline to Poland got halted at the end of February, we see now that the gap is getting wider and wider because of that change as well. So all of this stuff can be verified. It just needs a deeper look at things. I'm kind of myself getting frustrated with the amount of headlines coming out of Reuters and Bloomberg that just look at seaborne exports and they say very, very interesting things on that. I think there's a Wall Street Journal article that came out just a couple of days ago as well, which was trying to make the case that Saudi Arabia and Russia are at war in this oil pricing regime, when I see no indication of that at all. In fact, Russia looks to have actually done what they said they would do. It's just that the one data point we're all using is not that all that accurate. Okay, we also have OPEC plus exports. So we looked at Russia. Now we look at OPEC plus, which includes Russia as well. So pretty decent trend. We do see this May cut being implemented pretty obviously. Here are your 4 weeks in April. Here are our 4 weeks in May thus far. And this is a pretty significant drop because this is counting in per week barrels. So 1.5 million to 2 million has been cut. And when we look at this week itself, the cut was over 3 million barrels. So there is specific weeks in here that are being cut even more. And this includes Russia. So far, so good. We'll continue to watch this trend as it goes on. The other major factor is the Chinese imports. So we know that China, of course, is becoming a bigger and bigger consumer, despite all the talk I heard about reopening is not going good. There's just a piece put out a couple of days ago that the apparent oil demand in China in April was the highest ever, and it was 1 million barrels a day more than March. So, people are using the PMIs and the manufacturing data and the housing sales to make some sort of conclusion for petroleum demand, and it's just completely wrong. We have seen this trend occur in North America, where people are moving from ordering goods to spending on services. It's a very, very obvious shift that's occurred post-reopening. Why would we not expect the same in China? And especially when the government is now pushing for a consumerism economy. So I think the Chinese oil demand is going to continue to go up. It's going to deviate from what the demand looks like when you compare it to the PMI numbers and the manufacturing index and the housing sales and whatnot. And those are going to be further catalysts once those improve, or the government comes in with some sort of subsidies or stimulus in order to recreate those industries as the months go by here. So looking pretty good. We had talked about March being the highest import number ever from China, and April was 1 million barrels below that, over 1 million barrels below that. And now May, I believe, is going to be another all-time high. So here are our 4 weeks in May. you can see how compared to the 4 weeks in April, we are looking very, very strong. And then the four weeks in March here, we're looking even higher. We had this really, really high print one of the weeks, the first week of May, as of course, China is now preparing for that loss in OPEC barrels. It takes about 4 to 6 weeks, 4 to 6 to 8 weeks for the loss of those barrels to be felt on the incoming side, because of the journey that it takes from OPEC to China or India or North America. So we are getting very, very close to that. And it looks like China is wanting to import as much as possible. Same with India. So the Indian import number hit an all-time high in May, hit an all-time high this week. And the week isn't even over yet. So I expect to see this even a little bit higher. And this is a 2-year weekly import. This is going to be the highest number ever seen from India. So looking quite good. India is also obviously building more and more refining capacity, more and more petrochemicals capacity. So it's not unexpected that they would actually be importing more and more crude here as the months go by and as the years go by. And some major projects, like these are not just 40,000 barrel per day refineries or anything. Like these are multi-100,000 barrels per day, same as China. A lot of the Chinese refineries that have recently opened up have been 4, 5, 6, 700,000 barrel per day, massive behemoth complexes. So really, really helps the overall crude processing side of things, because remember, it's the refineries that buy crude, not the end user. So looking good. I mean, the fundamentals have never really deviated from what we had initially discussed right from the first macro outlook in October of 2021. The fundamentals have always looked good. And now we know we have OPEC underneath us to provide that support, and they're walking the walk. So far, they have been looking really good. And we're just going to see as the months go by if somebody cheats. But for the last 2 years, we had no cheating in the OPEC side of things. So I think looking pretty good. And we're in the structural cycle where it's not solved unless we have more supply. We are not seeing more supply. And the main one there is the US. We talked about this with the rig count. You can see how the US was growing pre-COVID, million plus barrels per day on crude, and also 500,000 to 600,000 barrels per day growth per year on NGLs. This year, you can see the trend right there. You can see the second trend, a lower slope. And now you can see your third trend developing, where this is not the most accurate way of measuring US production, but the weekly numbers are now flat. We are now at 12.3, and we first hit 12.3 a few months ago. We first hit 12.2 back in August of 2022. So relatively flat. And keep in mind, in this is about 250 to 300,000 barrels of Gulf of Mexico growth that's occurred over the last 6 months. So you take that into account, we can reasonably conclude that shale is not doing too well if the overall production is flat, yet the Gulf of Mexico added 300,000 barrels in the last 6 months. So I'm going to be looking forward to this trend going down now as the months go on, the impact of the rig count and the frac fleets to be felt and really make their impact. But this is already a big change. So for anybody that's arguing that we need to see massive drop-offs in US production for it to be a bullish catalyst, not really. Look at this trend. Look at what we're going up against. We're going up against 1 million barrels per year of growth. We are now at 0. So there's a big shift already. And as the years or as the months go by, if we see a drop, that is a complete narrative reversal that is going to be quite shocking, I think, to a lot of people who are not looking at this data or the shale data in detail. Big four storage, so crude plus SPR, plus gasoline, distillate, and jet fuel, the ones that matter. We are 125 to 150 million barrels below what we were last year. The trend is now continually going down. So even though commercial crude inventories are a little bit higher, the SPR is a lot lower. Gasoline is still lower than last year. Distillate is now lower than last year. And jet fuel is looking relatively flat. So The overall products in the US that have built are propanes and other oils. They are about 40% more than they were last year for propanes, and about 10 to 15% higher on the other oils, a lot of which is your NGPLs, natural gas plant liquids. So we're talking butanes, ethanes, low value products that don't have much use. And even that is now stopping. The growth on that is stopping year over year because US gas production is now roughly flat as well. Not year over year, but over the last few months, and looking like it's flatlined, especially with the declining rig counts in US gas as well. Here's distillate stocks. So as I mentioned, we are now negative year over year on the distillate stocks. The trend is just continually going down, and the refineries have not kicked on to the point that we can rebuild our diesel stocks. So once again, think about it this way. If commercial crude is 40 million out of whack, or it's too high, well, distillate inventories are 30 to 40 million barrels below where they should be, in terms of the 5-year average, in terms of the pre-COVID average, in terms of the stocks we need in a well-functioning economy. So there is a dislocation here that we have a little bit extra crude, but we have way less products. So as that normalizes, with now refining no longer being a problem globally, maybe in North America it still is a restricted environment, but overall looks like the global refining market has gotten better. We have excess refining capacity now, which should rebuild products at the expense of obviously crude inventories continually coming down. Here's gasoline below where we were last year, which was already 20 to 30 to 40 million barrels below what we required, going into a very curious summer driving season. This is going to be a driving season that's after a pent-up demand year, yes, but also gasoline prices are 30% below where they were last year, around this time. So obviously a extra boost there to consumption, and also the US vaccination requirement has now been taken out. So a lot of people that would come into the country are going to go on extended road trips. They're going to go to the nature areas, which kind of artificially creates more consumption per person than if we had less tourism. So looking really good from the gasoline standpoint as well. Now let's look at frac operations. So we looked at the rig count. We look at frac operations, same trend. We had a max out in October, November, looks like September, October actually. Then we had a decline, a seasonal decline during the December, Christmas time and the winter time. And then we had a huge ramp up in January as they had some DUCs in December. And now we're seeing a declining trend again. The April number of fracs were all the way back here to the November level. And really, we are all the way back to the early 2022 levels there. This May number, I believe, is inaccurate, and I can justify that. What Rystad is saying, there's 895 fracs that were started by May 24th. Yet they're saying there's going to be 462 in just the next week. So the numbers don't really add up. I think this is going to be revised down here as the next weeks of data comes out. And I think we're going to end up even below April, which again is now back to the February, March, April timeframe. And that's, I think, where we're going to continue. The frac fleets are coming down. Last week's print was 260, which is again 10% below where we were last year. Everything is just coming down. Everything is softening. And there's a real impact to that that's already been felt with the US production. And now as the rigs are being dropped, more and more and more impact is going to be felt as the year continues. Obviously at a time that OPEC itself is restricting supply from their part. So I know there's a joke going around Twitter about the OPEC plus that includes the US. So it is coming to fruition already, and it will be an even bigger impact as the year continues. Here are the number of fracs in the Permian. So you can see the April number here is back where we were again, where we were last year. And we have the May number still lower. Other oil also looks to now be declining. The same trend. I keep repeating myself, but it's the same trend. We're seeing a softening here, and US shale production can drop off very, very fast if the legacy production is not being maintained with the continual fracking and drilling of new wells. From the gas standpoint, an even bigger loss. So when we look at the April 2023 fracs in US core gas, we are back to levels seen in late 2021. So even though the rig count took a little bit to drop, the fracking count actually dropped right away. Well, maybe not right away, but earlier than the rig count. And again, US gas is also a lot of shale gas. So pretty high declines on this too, not as much as oil because of the associated gas portion of the US natural gas production, but still, there's going to be a real impact to this, and why I ended up making some bets 6 to 9 months out on US gas when I saw this frac count continue to drop. And even the May number might actually uptake a little bit more, but still well below the second half of 2022 and the first quarter of 2023 number of fracs that were being done in US gas. Really bizarre. The number of gas fracs being done in the Haynesville and the Marcellus at $2.50 gas. It's really bizarre to me. I think some of these have been caught up in contracts. So some sort of long-term contract that was signed. And so the frac fleet has to stay online. Unfortunately for the producer in this case. Frac spread count, same thing. We saw a little bit of an uptick according to what Rystad is pulling, but the previous week was the lowest week in over a year. So not only are rigs being dropped, the frac fleets have now started to be dropped in a major way, and a continuation of the same trend. So I think I can talk about macro all day, as many of you have seen in my other macro outlook presentations. So moving to this brief macro updates every few months, I think is just a better way to do it. So that's that on the supply demand side. When we look at the demand on flights, this is our overall total commercial flights. So pushing 2019 levels, we are now above the 2019 levels on total commercial flights. This bottom graph is China to non-China. So Chinese international flights picked up materially where they were the last 3 years. We are now seeing a little bit of a flat line. And then when I look at the forward-looking schedules, about June 15th looks to be the date when we see this next rise. And the next rise actually is not from new flights being added. It's not from new routes. Yes, there is still new routes being added in China, but a lot of the increase is going to come from increase of routes. So something like a Beijing to Australia or going to Europe, those flights are going to go from like 2 times a week to 6 times a week, or from once daily to 3 times daily, which is where your big increase in flights is going to come from. So the airlines have already started those flights. They just haven't increased the frequency. They're still waiting for that demand pull to see how that plays out. There's no reason to start a flight and just go crazy with the number of offerings you're having. You might as well start off slow and then ramp them up. But the point I'm trying to make is the slots have already been allotted. The airlines are already working those routes. They already know what the demand is going to be. So it's less of a hassle now to add flights as opposed to the restarting of new routes, which is also happening, but takes a little bit more time. You got to get your gates set up. You got to have the right slots aligned. You got to have the right air carrier authority approvals, et cetera, et cetera. Okay, the other one we have here is, if I remember correctly, this is the Japan to non-Japan flights. So along with China, we're seeing an overall opening in all of Asia. So the Chinese reopening, quote unquote, is not just China. We are talking about the overall Asian complex. China has a major role to play in business, tourism, manufacturing, trade between all these countries. So we're seeing Japanese international flights also up about 20% compared to the beginning of the year. And look at it compared to last year. We are up more than 100% compared to last year. So although 2022 was a nice year for petroleum consumption, Asia wasn't even really part of it. So as we now grow here, I think this is what's causing a lot of the problems in people looking at North America or Europe and saying, recession, oil's gonna drop. Well, the Asian market is up 50, 60, 80, 100% in certain cases on their travel compared to last year. So looking really good on that standpoint. This graph here, I actually don't remember what I graphed, but essentially we're looking, other parts of the world also are now above 2022, but not yet to 2019 levels. So even though we're much higher than last year, there is still a recovery to go. And when we look at global airline travel, this is something that was growing at 5 to 6 to 8% year over year pre-COVID. So we need to make up for that growth as well. So a big factor still for the rest of the year. It's already been a major factor so far this year, and something that I continually track day after day and week after week. Okay, so now I've hit this point 2 times before in my presentations, and it's something that I now see happening again. So there is times that suddenly a Twitter crisis takes about, and there is certain narratives that just keep getting pushed as this major collapse of society is coming. The US debt ceiling obviously is now one of them. The banking crisis was another one. And the funny thing is they keep using the same data points year after year after year, and the data points have no basis in reality because they are fact. It's the same fact that just keeps getting repeated to make some sort of statement, yet the economy and society has continued to function under those parameters for many, many years. So here's one of them. And some people who have been following my presentations will see this as a deja vu. But I do think this point is often missed, and it's so easy to prove. Here we go. So the living paycheck to paycheck argument that comes up. So I just saw this recently that, hey, there's so many Americans living paycheck to paycheck, and because the student loan are now going to come due, all these people are going to default on credit cards and cars, and all these people are going to lose petroleum consumption. Well, the same headline. For those who are on the Zoom, you can see it a lot more clearly. For those who are on Twitter, you might have to check the YouTube once it's posted. But basically, the same headline: middle class living paycheck to paycheck, 2014. 55% of US households living paycheck to paycheck, January 30th, 2015. February 2022, the same headline. Even millionaires are living paycheck to paycheck, June 17th, 2015. 2007, living paycheck to paycheck, careerbuilder.com. Forbes, January 11th, 2019. Business Network, September 2010. The same headline. I have another 7 or 8 of them here. I'm not going to bore you with this, but you can see how, and I suggest you do this. Any narrative headline that comes up, go ahead, put it into Google, and then put every year, one after another, and see the results you get. Put 2000, put 2005, put 2014, put 2017, and you will get the same headline year after year after year, trying to suggest to you that the stock market's going to collapse, society's going to collapse, people are not doing too well, people are struggling. It's the same thing. And you know what? There is some truth to it, but not in this way, using it to make the same statement over and over and over. Here are more of them. So here's 5 more. The same exact headline. Here is the oil stocks are down as global recession fears bubble up. Does it sound familiar? The same thing in 2011, the same thing in 2012. Like we're talking times when WTI was over $100 a barrel. Oil drops $4 on recession fears. Oil down as US economy fears reemerge. The same headline, month after month after month, year after year after year. So when I get some DMs that say, hey, you know, I'm getting worried about this impending recession that is going to come and it's going to bring oil to $50 a barrel. Can my company survive 6 months at $50 a barrel? I just laugh, because the reason they keep putting these headlines out is because they work, because people get sucked into believing them and using that as the basis for why their stock is down or why oil price is down. But in reality, there are so many factors that play into this. So here's another one. The Chinese real estate property bust that is supposedly coming. The property sector now, I hear again, is going to collapse. Well, 2010, here's the headline: Beijing's challenge, China's post-crisis housing bubble. 2011, China's housing bubble and its future. 2004, Chinese housing price hike reasonable. 2011, Chinese housing bubble. 2010, Shanghai real estate is the most obvious bubble ever. 2014, China's real estate bubble. 2016, how serious is China's housing market bubble? These are all headlines from reputable sources, and they keep repeating the same exact headline. It is so mind-boggling to me. 2011, China's property bubble. 2012, 2014, 2013, 2017. It's the same thing. And now I see very, very well-reputable people on Twitter with tens of thousands of followers who keep saying the same thing. Oh, Chinese property has collapsed. There's no way this thing is going to come back. And I just go back and I say, you've been saying this for the last 20 years. The exact same headline, just waiting to be correct. So it's one of those things. They will end up being correct at some point, and then they will gloat in your face, yet they've been wrong the entire way through. So something that I see not only from narratives, but also from certain individuals who are trash talking certain stocks and just waiting for these things to collapse over and over and over. Well, if the stocks survived COVID, why would they suddenly go bankrupt now? So just things that boggle my mind. Here's one that actually one of the people that follow me sent me on my email. So this is not mine. This is what he sent me about the British property collapse. So he actually did something really good. He put everything in chronological order for me and then graphed the actual UK property price as well. So great work done. And look at this, starting from 2011, house prices to fall, house price crash, housing bubble 2013. This is A right here. And it's marked with A on this screenshot as well. Here's B, 2017, house price on brink of massive 40% collapse. This is the London Stock Exchange putting this out. 1 in 3 chance that London house prices crash. Right here, B. We're up 30% from A. And we did not see a 40% collapse. Hint, hint. Actually, things went much higher. And then 2010 or 2019, UK house prices heading for a post-Brexit meltdown. So the excuse just changes every year. Once it was the property boom, then it was a bubble. Now they blame Brexit. Now they blame coronavirus. Now they blame Chinese property investment. It just, the reason keeps changing, but the effect is always the same headline. So what happened? Nothing happened. C, prices are up yet again. And we all know what prices did in the COVID time. Further ramp up from there. Looks like a nice little graph of not just housing returns, but the stock market returns over the last 20, 30, 60, 100 years. So for anybody that's listening, please, whenever you see some narrative, there's a lot of people on Twitter, there's a lot of people in the markets who are brand new to this. They only started investing a couple of years ago. So all of this is new to them. They see a headline and they go, oh, things can really fall apart here or collapse. While they don't know that the same thing, like this is how the markets go. People run narratives, people run stories, certain algorithms push certain stories, and they have a real impact on the market and people make money from it. But the underlying supply demand has absolutely zero change. So yeah, some of the sources are not reputable. Yes, like I agree. But when I say reputable, I mean the average person believes these sources to be reputable. Financial Times, the Wall Street Journal, the New York Times, the Reuters, Bloomberg. The average person trusts and believes these media outlets, I guess is the right word. I'm actually not, I don't think I have any slides on the oil futures positioning. It's something that's been well covered on Twitter already. And it's pretty obvious what's happening from that standpoint, but I may have had a slide in here. I actually don't remember. So let's just see. But yeah, we're actually just yeah, we got a little bit more another topic I want to cover, and then we will get into the oil and gas software and tools portion. Once again, I should have said in my Twitter post that I will be doing a macro brief update and some narrative combat as well. So these are the narratives on what I call the headlines. So a lot of the big accounts putting this out and people listening to this. There's also certain individuals who have been completely wrong the entire way through. So many of you are well aware of this account. I keep getting screenshots of this WTI realist, WTI bull account as to what the individual is saying. And I am getting this from my investors that this seems like a reputable person who is making, decent claims out there. And what's your opinion on it? So I answer with my opinion. But reality, I say, look at the track record. But it's not enough for me to just say, look at the track record. Let me show you the track record. So the first article that was put out by this individual was December of 2022. The headline reads, Meg Energy, M for middling. Why Meg may not be what new investors are looking for. Okay, fair enough. December 7th, the Meg Energy price, the share price was $17.65. Today, it is $21.40. So we have about a 25% gain on this stock. And this individual managed to bottom tick the Meg Energy chart. The other one is Pine Cliff. So the comment was made. I've got my price target spreadsheets on my website. It showed Pine Cliff at a very, very nice free cash flow yield. That is really good at almost very, very low prices because of Pine Cliff's low decline rate, low cost of production. It's also a debt-free company with cash on the books. So I felt very comfortable putting a higher free cash flow yield on it and giving it the benefit of the doubt in my presentation or in my price target spreadsheet. And the comment that was made in January was Pine Cliff under $80 WTI and under $3 AECO cannot even cover a dividend and CapEx. So telling investors that you can't cover CapEx, you can't cover dividend. Well, WTI has been a lot below $80 for Q1. AECO was below $3 for Q1, yet Pine Cliff generated more than enough adjusted funds flow. They more than covered their dividend with less than a 60% payout ratio on the adjusted funds flow. And they also drilled 2 North Twining unit Pekisko wells in Q1. So things are looking as they are. The company is more than able to cover their commitments. They are more than able to keep their production profile good because it is a low decline company. They also have a lot of workovers that they can do to bring production back online. And it's a net cash company. So they are able to cover their dividend, no problem, even in this price environment for more than a year. So context, right? You have data that can be interpreted 2 ways, but when you get information being put out there with half-truths and misleading context, investors are led to believe that the company is in a poor shape when no problem at all here in Q1. The other one was the Athabasca. So the individual said Athabasca was the easiest short of their life at $2.70 a share. This was January 27th. Athabasca only hit below $2.70 once in that period over the next 3 months. And the stock price currently is at $2.98. And it went as high up as $3.30. So again, if you're going to be messaging me, asking me what my opinion is against other people, I've got my track record. Other people have their track record. It's important to keep things in mind as to who's making statements. The same way as news companies and media outlets, all they want is views. They keep putting out the same headline. They keep convincing people that they have some reputability. People keep listening to it, keep resharing stuff, spreading fear, doubt, uncertainty. The same thing happens with certain individuals. Very, very poor track record. This individual also apparently shorted Westcan Energy at 7 cents on January 27th as well. And the stock ran up to 12 cents the following day, the exact next day. And it's only been below 7 cents for very, very short periods of time, in which you can look at the volume bars. There's not been enough volume to cover this short. So another one where money was lost, despite the fact that this stock has fallen significantly from 40 cents to 6 cents. The decision when to short it completely wrong. Pretty interesting. Another narrative combat is the free cash flow narrative. So There's companies that are being targeted on Twitter that they say, okay, this company is not making any free cash flow. Okay, sure. Let's compare some companies that are not making free cash flow. In Q1, there's two companies that I know of, Obsidian and Birchcliff. Obsidian's production over the last year looking quite good because they are outspending their adjusted funds flow, which means they have negative free cash flow. Their production is going up. Makes sense. That's what growth companies do. The other company with negative free cash flow, production is going down. So you got to wonder, something has gone seriously wrong in other companies, yet they're not mentioned in these posts. Here is a G&A. So Obsidian, along with them increasing production, their overall corporate structure is looking a lot better. Other companies, despite declining production, their G&A cost is going up. So whenever you compare companies, just keep in mind there are certain companies on Twitter, on other platforms that are targeted without the full information being given. A lot of companies have negative free cash flow that are growing production. That's how a growth company works. Whether it's tech, whether it's oil, whether it's mining, it doesn't really matter. That's how these companies work. So always look at the message that's trying to be put out there. What are the underlying biases here? And what information are you not being told in this, which is some of this other information that's very, very important when you analyze things from just a free cash flow perspective. Here is Obsidian, the Q1 funds flow from operations, really, really good. The net income is a positive, whereas Birchcliff has a negative free funds flow and a net income loss. On top of that, because Obsidian's overspending their adjusted funds flow and has negative free cash flow in certain quarters, their reserves are going up. So as the production goes up, the reserves go up. So their overall BOE reserves are up about 25% in the last year. So December 31st, 2021 to December 31st, 2022. The other company with negative free cash flow, Birchcliff, the reserves went down. So along with production going down, reserves also went down. So the point I'm trying to make here is when you look at a company and you see a statement being made that this company doesn't generate any free cash flow, okay, we should look into these things a little bit deeper. Why is the company not generating free cash flow? If it's not generating free cash flow, is it at least growing production? Is it growing reserves? Is money being put into infrastructure projects in the company? And how much money is management taking to do all of this? If they're increasing their cost, their G&A cost, while they're not generating any free cash flow and production is dropping, now that's a red flag. If the company has negative free cash flow, but the production is going up and they made a couple of acquisitions and the reserves are going up and the company's not overspending on G&A, okay, that's what a growth company is supposed to be. So I think the interesting thing is a lot of investors, I think, don't have that time to do all of this. So they're being misled. The same way the headlines are misleading, the same way certain individuals are misleading you. Keep this in mind. Beware of wolves in sheep's clothing. This is true for any part of the financial space, but especially in industries like oil with very, very opaque data out there. Okay, so with that, we will begin our oil and gas tools and software part of the presentation. So a quick reminder for anybody on Twitter, if you would like to join for the Zoom visuals, whitetundra.ca, scroll to the bottom under events, and you can join in. And we'll go through some of the things that I use. It's just an information session. There's going to be very little for any conclusions being made, but I want to show you some of the dashboards out there that I use on a day-to-day basis, some of the information out there that may help you in your analysis. A lot of the stuff that I will discuss today is freely available. Certain stuff is paid subscriptions, yes, but I don't speak for any of the subscriptions. I'm just sharing what I have and how I use it. So a lot of you have seen my PetroNinja presentations. I talk about the well results. We look at the cumulative oil. We look at the overall productivity. So it's not new. So I'm not going to discuss that. portion of it. If you are curious, check out the PetroNinja wells update from May 7th of this year, and you can see that in more detail. But the other dashboard. So this is a dashboard that provides me the overall monthly production for a company. So right now we're showing March production still, but PetroNinja will update here in the next day or two to show April production. So this, we have Surge Energy up here. I have the daily average oil, I have the daily gas, the water production, and then the BOEs per day. So why is this important? Well, right now I only have the March production up on here, but I will get April, May, and June before the Q2 release of Surge Energy. So compared to other industries where you don't know what the companies are producing, because oil and gas is a provincially mandated, regulated industry, and we as the taxpayers get the royalties, in a sense, indirectly, everything needs to be public. So we can forecast every company's production and therefore their free cash flow and adjusted funds flow to a really, really good and accurate number even before the quarterly results come out. And it's much easier to, if somebody wants to play the earnings, to play them on a production beat or a production miss as well. And all of this is already out there. It can be easily calculated. It can be easily tracked. And what I'm actually going to do here in the next little bit is try and incorporate this into some sort of dashboard into my website, where we can then make forecasts for quarterly production before they come out. So certain companies we're not going to be able to because they report too early, but other companies we will be able to get a really good number as to where they are. Did they suffer any production loss? Did they have any issues with their new wells? We will know right away. The other thing I want to mention here is the water cut. So there's this false sort of conclusion or narrative out there that a high water cut means the company is not doing well. It means the wells are producing all this water. That's how a water flood works. So a water flood field, any company with water floods, Cardinal, Surge, Obsidian, Baytex, CNRL, Razor, all these companies with water flooding assets, what are they doing? They're injecting water, skimming oil, and reproducing it. So if you have the facilities, if you have the injection wells, if you have the overall system working, a high water cut means absolutely nothing. I used to produce wells when I used to work in Macklin that were 99.5% water, and we still made money on those wells because we had the infrastructure, because we had the facility, because we had the pipelines. Everything just ran, and the well just produced at a 0% decline rate for multiple years. So water cut is not a boogeyman. Water cut is why water flooding works. High water cut, I should say. This is another one that shows the wells. So another dashboard that just shows you all the wells in a certain area. You can go and pick them out. You can filter them by the date that they were spud. You can filter them by the formation. It just gives you an idea of where the activity is. You can filter them by different years and plot them separately as well. So this kind of gives me an idea of where is the activity occurring. So is there more activity suddenly in a certain part of the Cardium? Is there more activity in a certain part of the Frobisher in Southeast Saskatchewan? And should I be watching for land sales in that area? So just an overall quick check. I don't check this every day. This is more a monthly check. Just gives me an idea. Is there any new hotspots that are being developed as time goes on? We also have the rig counts. So we can see which companies have started drilling the day the well was spud, the formation on it, and then the Leahy class, which tells you, is it an exploration well? Is it a confidential development well? Is it a non-confidential well? We can see all of that in pretty much real time here. So, I mean, today's the 28th, so we don't have today's data, but we have as latest as yesterday's data as to who's drilling and even what rig they're using. So it's just fantastic to track which companies are more active, which companies are dropping rigs, may show you some signs of distress. So over the last 6 months, if a certain company has been dropping more rigs, you know that they may have some of the higher cost acreage, or they just don't want to drill their wells at a lower price. So it just gives you an idea of where things are going. Here's one that shows you all the wells with logs. So this is more so important if you're doing really, really deep analysis on a acquisition. So if there's an acquisition in a certain area and you want to go and look at the logs, all the logs in that area, different kinds of logs, I will be doing a full logging analysis tutorial. It's planned for next week, June 4th, but I think it's going to be pushed back to June 11th. But either way, I'm going to be going back to my petroleum engineering classes actually, and pulling up some of the notes and my textbooks from them, and sharing some of the information on how we do well logging analysis. So that will become more clear after that session, but we can track all the logs available and where we can go in and have a look a little bit more deeply into the productivity and prospectivity of the area. No, I'm looking forward to presenting the well logging session. It's also going to come with some economic analysis discussion. So how to value acquisitions, how to value a property, how to look at some of the other engineering topics. And I love going back to that technical part of my expertise and kind of just sharing that, because it's something that's not as openly available. And it's also not something that is easily understood. But can be easily understood, I hope, at least based on the presentation. So we also have really good data and dashboards on the IP rates. So this one, for example, is showing you the Cardium, the highest production wells in the Cardium over the last this is over forever. So these are your best Cardium wells ever drilled in terms of a 12-month initial production rate. So once again, this is something that I use not all that often, but enough when I see certain companies start very aggressive drilling programs. So let's say Yengera, for example, if I'm wanting to track Yengera and how their new wells are going to do, and I know where they're drilling based on the licenses and based on this previous slide with the rigs on them, what I can do is I can go in the area next to that. So let's say a 5-mile radius around that pad, and then plot the highest 12-month IP rates and see where they are. You will find certain areas have much better IPs just because of the geology has a natural fault. It has a structural change. There's not as much underlying water, or whatever the reason may be. It gives you a good idea, and it's a good way to figure out the productivity of where your company is drilling. So this was really, really important for Surge when they bought some of these Frobisher lands last year. It was very easy to tell that the area that they bought it in, when you looked around it, had some of the highest, not IP12s, but IP3s in the area. So it was just a good purchase from that standpoint. So there's a comment here that I reduced my Tamarack holdings. So I have not sold a single share of Tamarack. The percentages on the website can get different month to month, because if I sell a big position or one of my options expires, or I add a big position, as we have with the recent private placements, some of the other underlying legacy holdings get reduced in terms of their percent, but I didn't sell them. It just is a relative squeeze on that because of a new position that got added. Okay, so this one here is our frac tracker. So it is able to track what kind of fracs are being done, the number of stages, the water, and the proppant. This is more interesting for figuring out the overall change in mindset of the companies. So for example, ARC Resources, they are suddenly drilling really, really good wells in that Kakwa 7 Gens area. And we're able to figure out, okay, did they increase the proppant on the fracs? Did they increase the lateral length of these wells? Are they increasing the water per stage that's being used? And can that justify what's happening here? And if neither of those things have been done, and just the wells are producing better, that maybe may show you there's a change in the fracking methodology, or the way the wells are maybe left to sit for a month before they produce them. So it's just all these technical things that are becoming more and more important to track. Explaining why companies are able to produce a lot more oil suddenly out of wells is really important, because we need to know, is it repeatable or is it a one-off? Is it based off geology or is it based off engineering? Is it based off of a very small area here, or is it applicable to all their fields? That really lets you know how things are going to go for a company moving forward. And then the last one here I'll share is the land sales. So we can also track the land sales, who is going out and buying different mineral rights in the area, Alberta, Saskatchewan, and BC. I believe PetroNinja only has Alberta, but we can track who's buying them, when the sales are, what the bonus was that was paid, and what are the upcoming land sales as well. So all of this is trackable. The one thing, this is something that a lot of people may not know, is look at this, the people who bought the land. A lot of them are land companies. They are not your E&Ps, your exploration and production companies. So many companies will go and buy these lands through a third party, what we call land agents. The most known ones, Millennium, Lexterra, NRG, Meridian, these are very popular land sale organizations, and companies do this to hide what they're doing. If you're accumulating a big position, you don't want anybody to know until further down the road when you buy that land from your a land agent company. So it's becoming harder to track who is buying what, but it is also sometimes possible by just doing reverse analysis. So if you look at a company and they are touting some new position that they have, how many sections it has, you can sometimes go back to the land sale, figure out exactly if that section was sold, if that package of sections was sold, and then correlate to who bought it. So one of the private placements that we did late last year, I was able to figure out a 15-section block that was bought at a land sale strictly by going and scouring through the land sales on here and where exactly they were in the province. So it can be done. It is being done. May not be as important to all investors, but again, this is me sharing how I use these things to figure out different things that are going on in the sector and also in my or our investments. And then the one other thing that PetroNinja has, other than the dashboards, is the fluid samples. So this is something I use sometimes to figure out what sort of price is the company going to get. So in the case of a company like Surge, they really went big into the Southeast Saskatchewan area last year and ended up buying a lot of land. They bought a lot of, 2 companies in that area. And I want to know, okay, what kind of oil do they produce here and what kind of pricing are they going to get? So you can get these oil analysis, you can get gas analysis, you can get water analysis as well. The oil is the most important because it tells you the API grade of the oil. It tells you the rough water content that's coming out, and then it tells you the sulfur content as well that's in the oil. And with those 3 factors, you can figure out what is the rough oil price that this company is getting. In Canada, it can make a massive difference. So the difference between a WCS and a Boar River and a WCS Plus, and then some of the Saskatchewan blends, the Midale blends, the pricing is a lot different. It changes the break-evens on the wells. It changes the corporate break-even on a company. What price are they good down to? And it also changes their overall netback, obviously, and the funds flow from that. So again, not something that I do very often, but when a company does do a new acquisition that is outside their main area, it is to me curious to know what kind of price are they going to be getting versus their realized pricing on their existing barrels that are already being produced. We also have viscosity. So, I mean, viscosity doesn't price into anything, but it could be important for people who are tracking Clearwater and other multilateral acreage. So if you're tracking any companies that are heavy into that and drilling new wells in multilateral areas, you do want to know the viscosity because it plays a massive impact to whether these wells are going to be productive or not, and how long are they going to be productive in the future. Okay, so that's PetroNinja. We will now talk about Vortexa. This is something that I use daily. It is a very, very powerful platform. I've been sharing a lot of stuff from Vortexa on my feed, whether it is the Chinese imports, the OPEC exports, the India imports, the onshore crude inventories. All of that comes from this platform. It updates pretty much in real time. So go through some of the features. Some features I use more than others, but I'll just go through all of them and kind of discuss them as I go, just to show you the level of data that's out there. So this is our active live map tracker. And there's a few things here. We can see every crude oil ship that's out there. It's labeled by these little blue marks. We can see the date of arrival. So how much oil arrived on every single day across the world. So this is effectively showing you the overall world crude imports, seaborne crude imports worldwide, and what the kind of distribution is moving forward, although a lot of ships don't give you the actual date of arrival until closer to, which is why the graph looks like this. We can see the top origins of where the crude is being shipped out from, the top destinations. We see the vessel classes that are out there. So how many are VLCCs, how many are Panamax, Aframax, etc. This is more so important for the tanker investors because they can see in real time which ships are being more used at a certain point in time. And then this I really like. This is our real-time crude oil on water tracker. So we get a real-time number on how much oil is in transit, how much oil is in floating storage. The discharging and loading is sort of our gray area there, but they usually add up 1-to-1. So it doesn't really matter. Why is this important? Because I can track in real time the amount of Russian barrels that are stuck or the ones without a destination. And this number has definitely gone up since compared to 1 year ago. I now expect this to go down again because a lot of Russian cargoes are finding homes, and also with less OPEC barrels on the market, there's going to be less oil in transit. It's just the way supply demand of this works. So this is my most used here. I do like to track the ships and whatnot. Like you can actually go to any ship, click it. It will give you the status of it. It will give you where did it leave from, where is it going, its speed, and what grade of oil it has on it, and the quantity of it. The dots here represent the confidence level. So 3 dots means they are way more confident on where this is going. 2 dots means they are relatively confident on the product and the grade of oil that is on board the ship. So you can really track any ship you want. We have tracking on the sanctioned vessels as well, the ones that are showing the fake beacons. We can track them as well. Once they discharge or once they load somewhere, that data gets fed into here. We can also track previous journeys. So we see this ship in particular is now going from Kuwait to Texas. Its last journey was from Singapore to Kuwait. Before that, it went from Fujairah in the UAE to Singapore with 948,000 barrels. So again, more so important for the tanker investors, but also it's just a cool platform to play around with, track different ships and see how they are. We can track, of course, you can see here the Suez Canal route. So European ships will come down here, go through the canal. We also see, of course, all the activity in the Strait of Hormuz here, and the overall Gulf countries, obviously exporting a lot of barrels from here every single day. The other thing we can see is the forward fixtures. So this, I think, is really important because it gives you an idea of what is the forward-looking imports. So yes, we know how much China is importing today. Yes, we know how much China imported in the last month, but we can actually get a decent enough idea of what is a forward-looking import and export schedules look like. And we can track things by tanker, by origin, destination, and then here is the barrels. So, here's the rates, and then the charter, who who is fixing the ship. And then we have the tons. So we can convert the tons into barrels to get our understanding of how many barrels of oil are on this. These are our VLCCs with 2 million barrels plus, and then you have your smaller tankers as well. And we can see kind of what the future looking schedules are like. And if we see a bust in the model suddenly, definitely something to track. Something like Chinese imports completely collapsing, or OPEC plus exports going down more. I think it's not as obvious, but with the right amount of work, it can be done and figured out. Here are the cargo movements that are already done or in transit. So the last slide was fixtures. This is stuff that is in transit as we speak or has already been discharged. So again, we have the charter, we have the product on it, the grade of oil. So we see here a WTI blend that got shipped out. It's going to South Korea. It will arrive on June 26th. So just more so for reference purpose and to see the rest of Vortexa takes all this data and puts it into very nice visualizations. So you don't have to do the work yourself on trying to analyze the tables, text and tables. And this is the same graph. So global crude imports. So we can see here how the trends are changing. We can compare it to 12 months ago. We can compare it to 24 months ago. And we can see a changing trend here where even though the imports look like they're rising, the crude exports now for the first time in 2 years are going to be negative, not just year over year, but even compared to 2021, we're going to be shipping out less crude in May of 2023 than we did in May of 2022 and May of 2021. So when we say the impact of the OPEC cuts is going to be felt in mid-June, this is what we mean. There's a lag time between crude exports and crude imports, and we're able to track that here on a day-to-day basis, going as far back as we want. Here is the main kind of crude flows view. So what it shows you is the cargo volume for whatever you want. This I have right now is our Chinese imports. So we can break it down by where the imports have come from. We can break it down by product, by grade, by location, by different kind of ship style, all kinds of ways to figure out exactly what we want to figure out. We have the cargo movements that specifically pertain to this. This is kind of funny. In this screenshot, I have an Access Western blend that is going, or that is being tracked here. So Access Western blend being the oil that MEG Energy produces. So it's kind of interesting. It's a grade. It must be sorted by grade, and A just comes up first. We can see the product arrival distribution again. We can see the destinations. Obviously, we're tracking Chinese imports here, so China is 100% of the destination. We have the origins of where the oil came from. Again, we have the vessel classes of what's being used over the last, I believe this is a 6-month chart. And then we can track things on a average basis. So total quantity discharged, but then per month, or average cargoes discharged per day sort of metrics. So as soon as May ends here, by June 2nd or June 3rd, I will be confident in the May Chinese import data, and I will come in and put that on my Twitter feed by using this number here, the average quantity discharged, compare it to the previous months, and then share that graph on the feed accordingly. So, okay, so we have the same thing, the same graph. This one is showing, I believe, Saudi Arabia exports, if I'm not mistaken, or no, Russian exports is what it's showing. You can see that other than the different side, the side view here, the side dashboards, there's other dashboards we can also run. So we can run it by the grade analysis. So how much oil is sweet, how much oil is sour. We can run the analysis even deeper. We can go how much is medium sour, how much is light sour, how much is light sweet. So really try and understand the market, especially important for people investing in the oil sands, the oil sand companies, because if there is a shortage of sour barrels, or if there's a shortage of medium heavy grade sour barrels, which we can track on the weekly trends, well, that's correlating to a stronger sour oil barrel price. It's correlating to a higher price for heavy barrels. And all of this can be tracked in real time by country and then by grade. The other thing Vortexa has is the floating storage. I've shared this on my feed as well, here and there. So we have our short-term storage, which is 7 to 30 days. So any tanker gets put into a floating storage category after it's been in the same position for at least 7 days. It gets put into our short-term floating storage. The long-term floating storage happens after 30 days. So after 30 days, it gets put into long-term floating storage, and it just gives you an idea how many barrels are out there in the market, floating around. Keep in mind, not all of this is excess floating storage. So we seem to have a floor of 60 to 70 million barrels that is just required for a global economy to function in terms of floating storage. So what this is probably emergency stocks that China stores offshore, emergency stocks that Europe stores offshore. There's some going to be in Japan and other parts of the world. Most of it concentrated in Asia, though. More than half, it looks like, is concentrated in Asia. Being that Asia is a big crude importer, it makes sense. Crude exporting countries don't really need floating storage. It's mostly the importing countries that need a little bit of buffer in terms of storage there. So looking pretty good. And this updates on the daily. So I can track this on daily. However, the last 7 to 10 days are not as accurate as the previous rest of the data. So, you know, the last week or so, I would not trust 100%. Anything before that is looking really good. And you can see a bit of the destocking that's occurred in the last 2 months. So we've gone from 115 million barrels floating storage to about 75 million. That is a big number. That is almost 700,000 barrels per day of floating storage that's come off over the last 2 months. We also have our onshore crude inventory gospel. So this tells you what the overall onshore crude is across any country. We can also track it by specific pads. So pad 3, US Gulf Coast, we can track it by specific areas like Cushing or Patoka or Hardisty or any terminal that's out there. And we get a good trend line week by week. This updates every Wednesday at 5 p.m. Pacific time. So basically Wednesday midnight in the UK is when it updates. And they also have been adding barrels to their tracking. So the overall capacity that they're tracking has been going up. It's gone up by about 125 million barrels in the last 3 months. That's from new refineries in China and their tankage. There's also an addition made to some of the US storage over the last few months as some new tank farms were brought online and operational. But really good tracking. We can track the tank utilization, or we can track by the number of barrels that are in that area. This, what I have right now, is US crude inventories. So you can see the week over week change and then the month over month change on it as well. So that's Vortexa, pretty straightforward platform. It's more a customization platform. So they have the main dashboards, and basically we can customize it to, do we want imports from this country? Do we want exports from this other country? Do we want to see onshore crude inventories in a certain part of the world? Or do we want to see it in a certain specific tank farm at a specific refinery in the US, let's say? So very, very customizable, very good data and real time on it as well. And I will continue to share more information from that platform on my feed here as I go on. Vortexa also has a monthly, or not a monthly, but a four times a week newsletter that they put out, where their analysts will go in, make their own interpretations on certain data that they're seeing, and send it out as like, look, this is what you should be watching. This is what we are tracking. And they also share stuff on the rates, the tanker rates, and the crude imports and the product imports as well. So I only have a crude oil subscription. Other people also have the products subscription that can track gasoline, naphtha, LPG, fuel oils, and everything else. I just don't feel like that's as important to track, because crude is what drives the overall oil pricing regime. And we have really good data on product demand anyways from other sources. Okay, so the next one is NoviLabs. So this was used to be known as Shale Profile. NoviLabs has bought Shale Profile as of about 6 to 12 months ago. They've incorporated a better data tracking into it. They have incorporated actual live information from the producers themselves as far as US production goes into the platform, and added on a bunch of new dashboards. So I'll just go through them, how I use them, and we'll have a couple of case studies in here that show you how I've used these in the past to make conclusions on M&A, on certain companies, on their production profile going forward, etc. So before I begin, a quick reminder once again, anybody who is on the Twitter space, if you would like to join for the Zoom session, please go to whitetundra.ca, scroll to the bottom under events, and the Zoom link is in there. Okay, fantastic. So NoviLabs, what we have is our main dashboard. So this is our production profiles with map dashboard. It basically shows us all the wells and their production profile. So month by month, here we have time on the bottom. We have barrels on the left side. We have all the states that are covered. We have all the years that are covered. And we have the different lines for each of the years that are in here. And again, this is a very customizable platform. So you can do it by the different states. We can do it by the different companies. We can do it by different counties, different year of production. We can group wells by all the same metrics. And we can adjust the chart for rate versus time, cumulative versus time, or rate versus cumulative as well. We can normalize the graphs. So no normalization means each well is taken as is. We can normalize it by the lateral length of the well, and then we can normalize it by the proppant that was injected into the well also. And then we can show the wells on the map however we want to. So we can figure out, okay, where are they drilling? So for example, I haven't really shown it here, but I can run a specific customized map of, let's say, EOG's wells for all the years, and then separate them by the years. So I can see which areas they've drilled every single year based on the lines and the colors of the lines on it. So you can kind of see, okay, are they going outside their core? Are they going in the into more of their core? Are they going into a brand new area here that they have never gone in before? Are these new wells? So a lot of information can be determined just from this one platform. Here is the cumulative versus time. And so now we've gone from rate versus time to cumulative oil produced versus time. And we've normalized it for lateral length. So you can see we can make different kinds of conclusions. Okay, the well productivity was going up every single year. Track it from here, 13, 14, 15, 16, 17, 18, 19. And then 2020 is right there. 2021, they high graded the production. And then 2022, you see, is our first or second year of productivity degradation here for this specific example. So very easy to tell. And we see 2023 here in the dark blue just starting. As the data comes in, we will see more and more of this, how the 2023 line is progressing. But very, very simple to tell how is the overall US production doing in terms of the well productivity. And then we can go into it by areas. So, okay, Lee County is our big growth wedge. How is well productivity doing there? And that's exactly what I shared on my feed about a week or two ago, and got a lot of buzz on this shale productivity degradation. So you can pull out pretty good conclusions very, very easily on this. Don't need to go and do a lot of work. The platform is very, very fast, and it has a lot of data in there for all kinds of companies. The other platform we have is what we call our total production platform or dashboard. So we can see here the total shale production in the US. We had our first peak, a massive drop off. And when I say shale production can drop off, you can see it right there. This is about 1.5 million barrels per day that dropped off in a matter of months. And it didn't come on right away. It took a little bit of time for that production to come back online. So it was a big decline, and we see 2023 is not really off to a good start. So there is a little bit of production missing. This is not entirely 100% accurate, but you can see the trend here. Even going back 6 months ago, a lot of the data from this point is in at this point. So I guess we'll continue tracking this as the months go by and see how overall shale production is doing. The same graph can be put by specific area. So this, we are looking at Howard County. We had discussed Howard County earlier being one of the big, where a lot of rigs had gone dropped. We went from 25 rigs in 2022, 2Q to 3Q 2022, to now being all the way down to 10 rigs. So a lot of rigs have been dropped, and we can see phase one of our growth. We can see phase two, the 2020 flatline. We can see a big slug of wells that came online in the second half of 2022 because of all the rigs that were active in the first half of 2022. And now we're seeing a decline here because of the fact that the rigs have been dropped, which means the frac crews have been dropped. And I'm going to track this county in particular because I think it makes for a really good case study on the ramp up of rigs and then the ramp down of rigs. But we don't have the data yet to make the conclusions. We need about another 6 months to really see this and how far it's going to fall from its low peak here in late 2022, it looks like. The other thing in this county was there was an acquisition made. The reason why I'm going to use this as a case study, Howard County in particular, is because Canadian companies are going into some of the US shale areas now. We saw Baytex with their Ranger Oil, and we saw another company buy some royalty lands in Howard County last year as well. So this is the three companies involved in that royalty transaction that the company bought royalties on these three companies' lands, in particular in Howard County. So it makes for a great little case study. They look like they've done really well because the production has gone up materially. And of course, being a royalty company, you want higher production on your assets. But the latter half, you can see the decline here is just crazy since it hit its peak. And also, of course, as I shared before, this is exactly where the rigs were dropped. When we look at Howard County, this one, our light orange line, we saw this massive drop down in rigs, and a lot of that has been very, very recently. So we are going to see the production looking not that good here on this. And you can see the decline rate on it, even when there was a lot of rigs active. Now as the rigs are being dropped, does this county end up going even below 2022 levels all the way down to 2021 levels? It will give us a good sign of US shale production overall and what it's doing. But just to show you what I use this for, because I'm not familiar with US geology as much, these types of platforms really allow me to figure out when Canadian companies are doing acquisitions in US, or even US companies are doing acquisitions in US shale, how to figure out, is that production good production, or is it a high decline production with very low inventory? That's a question we're trying to answer, and we're very easily able to do so here when we look at the fact that this Canadian company bought the asset, production jacked up, and then now we're on our decline phase already. And on top of that, the rigs have been dropped, which makes me think, okay, the acquisition may not pan out here based on the activity, the rig activity that was being guessed when the acquisition was made in June. So not only can we look at acquisitions in real time, we can go and rate them after the fact based on how many rigs continue to operate in that area and what the production profile looks like. So obviously the company that I'm talking about is Freehold Royalties. They made an acquisition for $123 million US, or yeah, I want to say actually Canadian dollars, $123 million Canadian. They bought assets in these three companies. Bayswater, this orange area, you can see how it's fringe on the edge already. Just by looking at the map, you can see it's not in the core Howard County. It looks like it's in the edge where nobody really wants to be. The other company being Surge Energy, the US Surge Energy, not the Canadian Surge, which is down here. And then the third company that they were involved in is to High Peak Energy. So again, on the fringe side of the Howard County, it becomes very obvious to see that the acreage that was bought was not very good. The price paid on it was very, very high compared to what Topaz and Prairie Sky Royalties has been paying. And then now we see a loss in rigs. Therefore, I can conclude that the acquisition is likely not a good acquisition that was made. And of course, nobody could have foreseen that rigs in Howard County were going to be dropped. But given that we are where we are now, it's very easy to conclude, okay, if rigs were a lot higher, maybe the acquisition would have been a lot better. In this scenario, we can say so far, not looking so good for them. I can make similar conclusions as to what Baytex has bought from Ranger Oil. So this here is our completion versus production chart, one that I use very, very, very often because companies are moving to longer laterals, they're moving to more proppants, they are hiding their well productivity loss by drilling these 3-mile laterals and jacking up the proppants. You can see the amount of proppant that's being used. It went from 10,000 times 1,000 pounds in 2016, 2017, 2018. We more than 3x'd the amount of proppant that was being used in some of these wells. And you can see the increase was justified because the well productivity did go up. But I would like to point you out to one dot here, this one right here. In 2022 Q1, the Ranger Oil team went in and they increased their lateral length massively. A immediate 15 to 20% increase in lateral length. The CEO of Ranger Oil is on record saying that the increase in lateral length is going to be the next phase of our growth, the next catalyst, the next boom for Ranger Oil. Look at the production. This was the lowest production that they had in multiple years when they increased the lateral length. Proppants didn't really go up, but the lateral length went up and the production was actually going down. When we normalize this for lateral length, so this is just by well, now we're going to normalize production because the well is longer. And you can see this was one of the worst production per 1,000 foot that Ranger Oil ever got. So meaningfully, what I can conclude from this is in the Eagle Ford, most of the companies are still at 2-mile laterals, 1.5 to 2-mile laterals, and that is the optimal design. Companies should not be going to 2.5-mile laterals, and any company that goes out and says that, track their production metrics very, very carefully, keep an eye on them, and you can see Ranger Oil has come back to these 10,000 foot laterals, and so they will not be benefiting from any sort of well economic increase from longer laterals that we're seeing in the Permian. So just one case study, but the data is so overwhelmingly obvious as to what it's pointing out that, okay, we can't say yet whether Baytex's acquisition was bad, but we can conclude for sure that they're not going to benefit from a longer lateral methodology that their peers in the Permian are benefiting from when it comes to a per well economics sensitivity. We can also see our lease acreage. So this is Lee County in New Mexico. You can see how it is pretty obvious where the core of the Permian is here in the Delaware Basin. All this acreage is just excess acreage. So you'll see companies going out and saying, we got 300,000 acres in Lee County, very prospective acreage. It's very easy for me to open up this map, look at the company, where their acreage is, and figure out, okay, is this legit acreage, or is it just something they bought way on the north where the actual Permian Delaware doesn't even exist, or if it exists, is not that productive. So very, very easy to tell. Here I have caught companies that have been making claims about owning acreage, all this acreage that they have. You can see here already certain companies like Chevron, for example, has all this acreage up here where there's literally no wells drilled. So yes, does Chevron still have really good acreage in the Delaware? Sure, but it's definitely not to the extent of anybody who would just run okay, they've got this many acres, they can drill this many wells per acre, so they have these many locations. If you just use that math, you're way overestimating how many actual locations does the company has, because of the fact that they have acreage in random places. And the same can be said for Canadian companies. This is not a US phenomena, but it more so applies to shale than it does to conventional acreage. Here is another case study. So here we have our Delaware Basin in the Permian. And what am I trying to figure out? This is what we call our, I actually don't know the exact name of this, but it is a well productivity dashboard that looks at how many wells are close to you. So why do we want to look at this? Because there are specific companies that have wide open acreage. There's specific companies that are now doing infill drilling. So they drilled on a 80-acre spacing. Now they're infilling that with a well in the middle of it, which is obviously not going to be as productive as the parent wells, and the reservoir has already been depleted in that area, assuming, of course, that they're drilling into the same zone there. So here we're seeing is how many wells are in close radius to the well that you're drilling. Naturally, as the years have gone on, the Permian is getting more and more and more filled up. So each well now, on average, has 7 wells in its close radius that is being drilled. So anybody using the Permian and running the same growth graph on it is not taking any of these things into account. We talked about well productivity. We talked about acreage degradation. We talked about the lateral lengths being longer and how that reduces the number of well locations you have. But also this, we're going to see more and more interference in wells because of how close they've now gotten. And what does well interference mean? It means I could have a well making 50 barrels per day and another well making 30 barrels per day. I go and frack in the middle of it. Now the new well is making 800 barrels per day, but you actually killed the older 2 wells. Because those 2 wells are now in a low pressure regime, everything flows to the higher pressure regime well, and you've killed those 2 wells for bringing on your new well. So something that is very, very rarely discussed in this is this parent-child well interference. And we can see that by looking at the statistics. This graph is telling you how many wells are in the close radius and what is the 24-month cumulative oil produced. It's not a surprise that the more wells that are in the close radius, the less oil that those companies produce out of those wells. It is not a surprise, but yet it shocks people when it's being pointed out that we're now at 7.5 to 8 wells in close radius. So we've already lost all of these wells here and the increased productivity. What happens once we're on to 10, 12, 14 wells in close radius? You can see the further degradation that we're seeing in these. Yeah, somebody requested to record, so I'm obviously not going to allow anybody else to record. If you have some software that can do it naturally, go for it. I can't stop you, but this is going to be on YouTube anyway, so I'm not sure why you would want to record this. So yeah, anyway, to each their own. This is another one that shows us the so this was showing us the number of wells in close radius. This now shows us the maximum distance to our closest well. So you can see the maximum distance to our closest well is getting less and less and less as well. And we're now at peak saturation, where really any new well is just continually downspacing further and further and further in the same areas, leading to more interference and parent-child well conflict and production loss. This last data point is obviously not correct. It always happens this way, where certain wells will come in and we can't use the last 2 or 3 data points of the data set. The other thing Shale Profile has, which a lot of people will, I think, enjoy playing around with, I don't, but it is a production estimation graph. So you can put in monthly change in rigs, you can put in the monthly change in the wells drilled per rig, a change in well productivity. There can be a second period and a third period, and we can run things on the Permian and overall shale, or even certain companies as to how the production is going to look at a certain rig count and at a certain well productivity. So the reason why I don't use this is because I think the model is wrong. So the model here is showing that if rigs continue to get dropped, which is what I've put in, production will continue to grow for the next 2 years. Obviously, my personal model disagrees with this. So it is a model, and you can kind of use it and then make your own adjustments to it as well. But it's a great tool for people who are looking to understand what does a change in rigs do, what does a change in well productivity do, and what does a change in the fact that they're drilling longer wells means the monthly wells drilled per rig is going down. So what does a change in that do? You can put lead times, you can put all kinds of things in here, and a really good resource to understand the impact of these different parameters, more so than the actual production model that's being spit out. Well permits. This is a very, very important dashboard. This tells me what the future production is going to be based on how many permits have been given out. So you have to have a well permit before you put a drilling rig on site. The permit has to be approved. So what do we see here? April 2023 permits in the US were the lowest since February 2021. More than 2 years. It's the lowest in more than 2 years. This screenshot was just taken yesterday. You can see how the May number is looking very low as well. Might end up being even lower than April or on par. So not only are we seeing rigs drop, not only are we seeing frac fleets drop in the US, but the permitting activity has fallen off a cliff. Might be some foreshadowing for what is to come here in the next few months, and especially by August, September, October time for US shale production. It shows approved permits, canceled permits, and then completed permits. Obviously, completed permits are the wells that are being drilled and on production. And then these permits last for 2 years. So you can see here, anything after April of 2021 now, or anything before April of 2021 that has not been completed has been canceled. There's also some cancellations because companies will just give up permits that they know they're not going to use. Or some permits have only a 1-year cycle, I'm assuming as well. So overall, this trend is looking like it's going down again. And you can see compared to pre-COVID, we are already quite a bit down on the number of permits. This is the same permit map for Lee County. So we can see a slowdown in 2016, the big ramp up, and now we're peaked/declining. You can also see using permits where companies are drilling. So along with the acreage maps, you can put the acreage map right on top of this map and figure out where are a lot of permits being canceled. If a lot of permits are being canceled in a certain area, that is telling me, okay, companies have drilled a couple wells here. They took a lot of permits out. They drilled more wells and they realized this acreage is not good. We cannot be drilling here economically. So you can just see there's certain clusters right there. There's a certain cluster right there over here. This is our New Mexico potash zone. So people can do some more research on that, but effectively because it's a potash area, it can't be used for oil and gas development thus far. We can see certain areas are just where more permits get canceled, and therefore areas that if your company has acreage there should not be classified as good acreage. We also have our heat map here on different parameters. So if I want to compare, this is the Bakken. If I want to compare in the Bakken, what is the structural depth of the Bakken zone? Okay, well, we can see it. We have our edge, which is shallower. And then as we go into the middle of the Bakken, it gets deeper and deeper where the actual Bakken zone is in the Williston Basin. And then we can compare that to the oil production. So this is split into five equal bars. Each bar has the same number of wells in this depth. And we can see that this depth, 8,463 feet to 8,657 feet, looks to be the most productive for any Bakken production. Now, the structural depth may not be as interesting to you, but the stock tank oil in place is interesting. So we can actually plot how much original oil in place is there across the Bakken. And you can see it doesn't exactly correlate with the structural depth. If you have a shallower zone that's a thicker Bakken layer, you're going to have more oil in place. And we see here, naturally, the higher oil in place we have, the higher our 24-month cum oil production is. When you have these lower oil in place areas over here, you can see the production, the 24-month cum oil production is just lower. So that's why when I talk about my investments, I keep referring back to original oil in place. You have to have the oil in the ground, not only to produce it, but because the economics on it are going to be a lot better when there is more oil in place. The production is going to be a lot better. And here, I mean, this is a US shale comparison, so it doesn't really compare. But for the most part, any place with higher stock tank original oil in place is going to have better recoveries over the first 24 months or any amount of period for that matter. We also have the rig count dashboard. So this is effectively my way of visualizing Baker Hughes. So it just breaks down Baker Hughes into the different basins. So the Baker Hughes rig count only gives you, I mean, it does give you basins, but it doesn't graph it. So looking at things visually allows you to see which acreages are dying. You can see the Eagle Ford is dying. We can see the Williston Basin, the Bakken, the huge loss in rigs that we see here. And we see the Permian obviously expanding, and then other areas also expanding, like the Haynesville, and then the some of the other basins here as well. But really, the lion's share is the Permian at this point in time. And we can further break that, or no, yeah, that's the only slide on the rigs. We can also plot it on a map and kind of see it based on the horizontal rigs heat map. You can see Lee and Eddy County have the most of them. Reeves, Midland, Pecos as well, being some of the bigger ones that have the rigs. The other thing we can plot is our well status. So here we have, I believe this is Midland County, is what I graphed, and we can see the number of wells. So number of producing wells, number of DUC wells, and number of inactive wells, which is our suspended wells. So as this goes on, you're likely to see the DUC count is going to further get restricted. The producing wells have to continue to go up. That's just the way that shale works. It is a treadmill. And then the inactive wells will start to go up as more and more older wells become uneconomic or hit their limit on how low of an oil production per day can they produce to. And then here's your same map on it. So we can see certain areas have been more so drilled up. We can see where the plugged wells are starting to accumulate. So very early yet for the plugged wells and the inactive wells, but you can see certain areas where whole pads have been abandoned, obviously shorter laterals because they're wells from 5, 7, 10 years ago. And then you can also see where the new wells are, which is our first producing wells, and then our DUCs as well, where they are in the grand scheme of things here. We see, for example, I've shared this before, is I think a lot of DUCs are actually working capital. So they're not actually wells that can be fracked. They're wells on the same pad as where a rig is currently operating. So they got to drill 20 wells and then they'll frack them all. And you can see here is a prime example. These are our DUC wells. And then we see wells that are being spud as we speak. So this must be one pad that is going to all get fracked together. And these DUCs are effectively working capital DUCs, not excess DUCs. The same can be said here. Here's Midland County, I believe. Again, we can see the change here. As the wells continue to go up from 2014 to 2020, you can see the production had a very similar trajectory. Now we're in our mature shale part of the cycle. Wells continue to go up at the same rate, but the production goes up at a much lower rate. We will now soon begin phase 3 of this, where wells continue to go up and the production flatlines or even starts declining. And that really is as simple as why my shale production model is different from Rystad's or Enverus's or any of these other modeling softwares out there. They are not taking this into account, that we've had a step change in various factors in the Permian all at once. And we are going to see that play out at a time when rigs continue to drop as well. So, okay, some of the other dashboards here. This is our total production dashboard. So we can show the top operators in a certain area. This is the Uinta Basin. We can see there's only 4 operators in this area, but you can graph this by county, by operator, by different zones, by different timing. Anything can be graphed. Gives you the top 5 operators. I use this very often to track the companies that are going to be the bad ones, that are going to grow production, and also the bad ones in the sense the ones whose production is really not doing well, because you can show the top 15 or top 20 operators and see, okay, if these companies are not growing production, this county is basically not going to grow anymore. It's really up to the main operators to grow. But I'll sometimes graph the top 25 or top 30 to see these small ones on the bottom that sometimes can come out of nowhere, small private companies, and really jack up production. But of course, that sort of acreage just doesn't exist anymore as it did 2, 3, or 5 years ago. And a heat map of that as well. The next one we have is the same graph that I used to generate the Ranger oil case study. So we have our cumulative production on the gas and then on the oil normalized by 1,000 feet. We have our production unnormalized, and we have our average proppants per foot and our lateral lengths of the wells. You can see they continue to go up as a way of masking well productivity. But once you normalize everything by 1,000 feet, things seem to make a lot more sense. This graph is a bit misleading because more and more wells are being drilled in Permian. So when we compare a US-wide comparison, it skews the oil production upwards because there's more Permian wells, which are better than all the other wells in the US. But when we run a specific comparison, this is Pioneer Natural Resources in the Midland Basin. You can see when we look at it specifically, the oil production per 1,000 foot has been declining for multiple years. There's an account, SRS Rocco, on Twitter, who I have to credit for this idea on this graph. I believe I did update the graph, but it is his idea. And basically, you can see the well productivity degradation and the continual degradation. We are now down to 2015, 2016 levels on certain names. And why Scott Sheffield has been so out there and saying we are suffering well productivity, we don't have the acreage. The data proves and agrees with him, obviously. And some other companies here as well. This was Pioneer. This is certain counties. The point I'm trying to make here is when you look at it just by per 1,000 feet, yeah, we see the decline. But when you compare the productivity by proppant, it's an even further decline. So all the companies have been doing is drilling longer laterals and jamming them with higher and higher proppants to show the shale productivity increases, and their time has come to an end. For anybody looking for more information on that, my last macro outlook was specifically on US shale. So you can see more in more detail what I'm trying to show here. This is more so just showing you the different tools that are available. We can also run well economics on exact wells. So if there's a company out there, you want to calculate their specific corporate break even, we can calculate it by looking at the ownership, the well cost, operating cost, the decline rates, NGL yield, taxes, differentials, everything. You can run this simulation per se and figure out, okay, what is the actual break even of this company on these parameters that are being run? And we can adjust it for productivity degradation and additional fixed operating cost, and then drill and completion cost inflation as well. This is our cumulative oil dashboard. So it just shows literally cumulative oil for all the wells averaged over the years. And I don't use this very much. I'd rather do independent analysis on specific counties, on specific wells or specific areas, but the dashboard is out there. We also have our daily oil production versus gas oil ratio. So we've talked about rising gas oil ratios in the Permian in the past, and you can see here the exact same graph showing the ratios just continue to rise. This is a pretty well-known phenomena in US shale and is going to become more and more prevalent with the bubble point depth and the boundary dominated flow characteristics that we're now seeing in some of these wells, and we'll see in all of these wells as time goes on. So when people say gas oil ratios are rising, the data is super overwhelmingly obvious. But we will continue to track this as the years go on and see how this shifts on the new wells. Do we end up seeing the graphs go up here and start off higher as the wells become more gassy to begin with? This is one of my favorite graphs, the well productivity distribution. So we can track average cumulative oil production in a specific area. So this is by sub-basin is what we have it. The thickness of the line represents the number of wells that are being drilled, and the length of the line represents the average well productivity or the average cumulative oil production in 24 months. So you can see how the Delaware Basin is just by far ahead of anything else. Partial Sanish is in the Williston Basin in the Bakken, very, very productive, but you can see the number of wells very low. Midland, Eagle Ford, Williston, and everything else is just not good. The Powder River and the Uinta can keep up, and then everything else is just way down here. So when somebody asks me, can there be another Permian Basin? Can there be something that comes in and replaces the Permian? Sure, but it has to show not just the aerial extent of the Permian, but also show the well productivity of the Permian. And nothing in here is even close in the rest of the US. The US onshore shale part of the equation. And here we have graphed this by county in the Permian. So I talked about Lee County being overwhelmingly the favorite. There you can see it. You see Loving County there as well, Eddy County, where the rigs are being added. So if 20 rigs left Lee County and they went to Eddy County, you can already see a massive loss in the well productivity and in the overall production that we're going to get, despite the fact that the same number of rigs are working. So I started off the presentation by saying this. Looking at just rig counts is great, but going into it county by county or company by company can give you more insights as to what exactly is going to be the trajectory of US production moving forward. And then as we go down, we see Reeves, we see Eddy, we see Midland, we see Martin, Pecos. And then I'm going to finalize my point on why I talked about Howard County. Of the counties with the most wells drilled, you can see how it's at the bottom. It is the one with the lowest well productivity. Therefore, it's not surprising that it is the one where the rigs are being dropped and have gone dropped materially in the last 3 months, 3 to 6 months. If the stock price, if the oil commodity price continues in this sort of regime for longer, I will continue to move up this and see, okay, the next one's being dropped will be in Martin County, then the Midland County, and then we go to Eddy. So it gives you an indication of what to look for and where you see economic exhaustion on these wells. And you see the rest of the counties are just not good. Therefore, they have very little drilling activity, which is again represented by the thickness of the graph. We can also run the same thing that I did for Ranger oil. So the lateral length and proppants versus the cum oil. We can run it for different basins. We can run it for normalized production. We can run it for different companies. We can run it by year of production. So here we see this is done actually by quarter, and then compared by basin as well. So all in all, to say there is such good customization on these. We can run a lot of things and really answer a specific question. If somebody asks me, okay, is Chord Energy's acreage in the Bakken, their existing acreage, better than what they bought from ExxonMobil last week? I can actually answer that question with hard data. I don't need to go and make speculation and opinion. I can actually give you the real graph that shows exactly the difference in productivity, the difference in well inventory, the difference in the lateral lengths, and make a whole case study on it and build a business case. And then, of course, I can analyze M&A transactions using that as well. So all of this is already out there. We don't really need to speculate. We have a dashboard on decline rates. So this one gives you our decline rate by year, so years on production, and then the decline rate based on each different year and when the well was drilled. We can do the same for different counties or different areas. So this is US wide. This is, I believe, Permian only is what I graphed here. And we can see the latest year is just one dot right up there. So the decline rates do taper down. However, the theory about late stage decline rates being 5 or 10% has proven to be false. We see late stage decline rates of 16, 18, 20% in certain cases, and they are staying there. So the wells that are older even continue to decline at pretty high rates. We have a peak production rate dashboard, so we can understand as the years go on what has been the peak production rate of these wells with our whiskers and our box. We can also figure this out for, again, a specific area that we want to target, and we can see we've seen good increase in peak production rates here as the years have gone on, but also a longer lateral well will naturally have higher peak production rates. But if you're declining from that peak production rate even higher, that's more and more barrels lost. So this is one that I don't use that much. I would rather just run a rate versus time or a cumulative versus time, but the peak production rate is available to see. We have well distribution, so we can distribute wells by their cumulative oil production for the last since 2001. When the data came in here, we can see the running percentage of the total. So how many wells out of this data set have produced how much barrels? So most of the wells here look like they're in the 20 to 150,000 barrel range. And then there's a few wells that keep going here. This is the same graph by company. So all I've done is I've graphed this just for EOG. And we can see EOG has a lot of wells in this part, in the 150,000 barrel cum production, and a few wells actually that are up 500,000 plus cum production. So what would I do here? I would go into these wells that are more than 500,000 barrels cum production. I would look at the wells, find out where they are, and then I would look, does EOG have more acreage in that area, or have they already drilled it all up? Because it's giving you an indication of where the sweet spots are. So Devon has had some sweet spots in the Permian. Oxy has had some sweet spots, 7, 8, 10,000 barrel per day wells. EOG has had some, Pioneer has had some, Chevron has had some, and we can figure out how many of that remain just by doing this analysis, looking at the really, really productive wells and looking at the acreage of where they are and comparing them to how much acreage is left in that specific area. The same way we have the gas oil ratio, we have a water oil ratio production. So this left graph is all of the US. This right graph, I believe, is once again the Permian only. And you can see the rising water oil ratios. So we were talking about this, that the Permian is becoming more and more water saturated. Lee County and Eddy in particular are higher water oil ratios where the rigs are moving to. And you can see that the lower or the lesser blue line is 2021, the dark blue line is 2022. You can see the ratios are not just rising, but they're starting off a lot higher, which is another headache for Permian producers, the produced water disposal, and then the subsequent seismic activity that causes. We have gas flared as well, not something I really care about, but NoviLabs does track the gas flared by operator. So you can track who are the ones that are most susceptible to possibly getting shut in the future if the RRC decides to do anything. And we have our total daily gas flaring and versus our production. So we can see since 2020, the gas production has gone up, but the flaring has gone down. So there is more rules that are coming up. And yet now for the last few months, the flaring has gone up again. So possibly there's a reason here. Maybe, hint, hint, the gas pipelines in the Permian are getting filled up. So there's less room there. And so a bit of flaring has to come back up. So you can make conclusions as to when the Permian gas takeaway capacity is at limit or reaching limit, because the flaring number will rise just slightly. And you will see that trend, and we can see it right there. And we have our last one, which is cumulative oil ranking. So what is the total oil produced by the company? We see EOG right at the top. This one is just the Eagle Ford. So I've compared the Eagle Ford and each county. We can see Karnes and DeWitt are way better than any other county. And these are counties that people want to be in. So we talk about the Marathon Oil acreage with Baytex is in Karnes County. So definitely some interpretations that can be made on the most productive counties based on the cum oil production. It also tells you a little bit about the recovery factors. So if you know the oil in place in a specific county, or you can calculate it, then we can run the cumulative oil production and say, okay, these areas have a low recovery factor, could be interesting in a high oil environment. At $120 oil, these low recovery factor areas might get targeted. But again, not something that I personally care to do the work on. It's not as important to me because I don't invest in any US shale producers. Okay, so that's NoviLabs. A little bit about regulator data. So only a few things here. The Texas RRC shares how many permits are approved in Texas as well. And you can see it by county and by operator. So this is, I believe, updated daily. And you can figure out who are the operators that are going out and getting permits, and in which counties are those permits being issued. So the Texas regulator does this for you. The Alberta regulator doesn't quite give you that level of data. You can create it yourself based on the dashboards, but the Alberta Energy Regulator has a PNOA, a public notice of assessment platform where you can see what companies are doing. So if you put in Spur Petroleum, CNRL, Surge, anybody in here, you can see what they're doing. They're building a new multi-well pad in this location. They are changing some of their pipeline requirements and approvals and authorizations. They might have the well licenses in here. They will have the any assets that they're selling in here. So you can really track companies. You don't just have to wait for the quarterly reports or conference calls to track what's happening. If you just search it up on here, everything is public. Where are they building batteries? Where are they building multi-well pads? Which tells you where are they going to be drilling in the near future. And then you can go and look at acreage in that area and see, okay, this is a well-defined area, or this is an exploration area, or XYZ company has drilled really good wells next to them, and now they're now going to drill their acreage and drill really good wells. So tells you a lot. And it also actually gives you the contact information of the person. You can figure out where what's being transferred. You can go and actually order the document itself. So if you want the actual application document, you can order the actual application document. I'm sure there's a fee for it, but if you're really wanting to know something, you can. So for example, this one, May 23rd, Surge Energy is transferring to Grafton Ventures 22 wells, 4 facilities, and 13 pipelines. Okay. If I really wanted to know what they're transferring, I can figure it out by ordering a copy of this document and get an idea of what's happening behind the scenes. Okay, we've got about a couple more things here to go, OAG and then RadarBox. Anybody on the Twitter space that would like to join for the Zoom visuals, whitetundra.ca. If you scroll to the bottom under events, you can join us for the last portion of the presentation. If not, the Twitter space will continue running here as well. Okay, so we've talked about supply, we've talked about demand, some of the shale stuff, we've talked about the overall global tracking on crude imports and exports, onshore crude. So we've discussed all those. Now let's talk about the jet fuel. So as I've mentioned before, the international jet fuel, I think, is a major factor for 2023. It is one that's already added hundreds of thousands of barrels since the beginning of the year and is going to continue to add hundreds of thousands of barrels each month as we go on here. So we want good data around this. And we have two different platforms, OAG and then RadarBox. So OAG gives you this every week. So we have the domestic seats for this week and the past, and also 11 weeks forward-looking. So forward-looking schedules are something that airlines and airports have to do so that they know, okay, next week, how many gates do we need? How many slots is this airline bringing in? So everything is already out there, and OAG goes out and they put it into a very nice visual fashion. You can see domestic seats, international seats, and that is a proxy for overall planes that are in the air, which is a proxy for jet fuel consumption. On top of that, they break it down by region. So you can see this week versus the same week in 2019 and what the domestic and international number of seats is. So we can point out things very clearly here. So certain parts are much higher than 2019. Then we go into South and Northeast Asia. You can see the international flights are a lot lower. Eastern Europe is still struggling with its capacity. And then we see certain areas where the Middle East, for example, is down 24% on domestic, but is up 3% on international travel. So focused more on long haul international travel, a less of an emphasis on the domestic travel. We also have the total seats by region this week versus last week. So you can see where are the changes occurring. Eastern Europe and Western Europe have grown 4% week over week. Why? Because it's European tourist season. So just certain things we can track week by week and then compared to 2019 and see where is the recovery still to come and what is the trajectory on that recovery as the weeks go by and then as the years go by. In a sense, we can also track it by top 20 airlines. So here are your top 20 airlines, their change versus May of 2019, their change versus last month, April 2023 as well. So these are the airlines. There's certain airlines that are up to 23% above May 2019 frequency. And then there's certain ones that are down 18, 20, 30% as well. We have global top 10 busiest international airline routes. This also updates on a monthly basis. So we can see this. We can see the global top 10 busiest domestic airline routes and also track that. We can track Southeast Asian recovery in particular and graph that. We can track the top 10 states where seats are added by month. So we see a big resurgence in California and Texas. A lot of this likely has to do with the tourism and the vaccination requirement coming out. A lot of it also has to do with that these two are the biggest cities or the biggest states in the US anyway in terms of population. But you also see different areas like Georgia has picked up. So why Georgia? Because Atlanta is the biggest airport in the world. It is a huge hub for United and Delta and all sorts of other airlines to use. So the fact that seats in Georgia are picking up gives an indication that the overall fleet in the US is looking really good. We got Illinois, Chicago, O'Hare. We have O'Hare Airport, I should say. We have New York, Washington, and you can track changes by states. Certain states have been a little bit behind in the number of seats added, so we can track that on a month-by-month basis. We can also track recovery of specific routes. So this graph is showing the China to X country demand. So China to Indonesia, Vietnam, Thailand, Malaysia, et cetera, and we can track the recovery versus 2019. So China to Thailand flights, the number of seats are down 28% versus 2019. So we can say, okay, recovery is still to come. Something like the Vietnam is up over 100% already. So that market has already recovered, we can say, and we can't expect too much more from there other than any new growth that's being created. And then there's other countries where we can expect increased growth plus recovery from 2019. Same thing by fastest growing airports by international seats. So for all the talk about China reopening fizzled out and it doesn't matter and things are woe is me, the society is going to collapse, etc. All these airports in non-Chinese areas are adding 6 to 8 to 10% seats per month. So Kuala Lumpur Airport is adding 8% seats every single month. What does that tell you for overall Asian recovery, Asian reopening, and how the overall business and tourism climate is shifting on a very, very quick basis here? So it is completely foolish to have believed that China reopening meant that all their business and all the tourism and everything is going to be back to pre-COVID or even higher right away. That's not how it works. Things take time in the real world. This is not SimCity simulation happening going on here. This is the real world. People have to go meet, make deals, make contracts. Airlines have to hire staff. Airports have to hire staff, baggage handlers, drivers, chefs. They need to get the whole supply chain working, and it is working. 8% growth month after month after month. Watch out, and we still have a lot to go just to recover, let alone any growth on top of that. We can track the busiest airline routes in the US, the exact routes by departing seats. So Atlanta to Fort Lauderdale, Atlanta to LaGuardia, LaGuardia to Chicago, Denver to Phoenix, Denver to Las Vegas. You can track different routes. Again, this granularity of data is too much, even for me. I don't need to know this much. But again, I'm sharing for people that want to track certain things, or they think a certain flight route means that there's a recovery in a certain part of the world, or a certain state or certain city. You can track all of this, and this is all free. I don't have a OAG subscription. They have a subscription model where you can get all the data and run things yourself, but their analysis is already so good that I don't need to subscribe to anything. Here is a recovery. So we see domestic and international recovery. This is a year-to-date sort of way of visualizing things. And it just goes to show you where we are on this. We have global top 10 busiest domestic airline routes. We have China, specifically China's top 10 busiest domestic airline routes. So we can track this on a Chinese specific basis and also track their domestic versus international airline capacity versus the previous 4 years. So a lot of data here, a lot of information. And the one thing that I would like to point out here is Chinese domestic flights in May of 2021 were 22% above May of 2019. So we are not just looking for a Chinese recovery back to pre-COVID levels. We are looking for a massive airline growth. And we already see that on the domestic side of things, which is already above pre-COVID levels. But we are expecting to see 20, 30, 40% above that as this reopening progresses. So all that in the face of Chinese apparent oil demand in April being the highest ever, and a huge growth over March already. And this is with their manufacturing and their property sector still relatively subdued compared to what it is going to be at or what it was at pre-COVID or even during some of the COVID time. So the Chinese reopening is on full blast. It's going as it is, and there's a lot more yet to come. And we can also track Chinese international markets by market. So the number of seats in May 2019, the number of seats in May 2023, you can see how we still have a lot of international growth yet to come, yet there is certain areas that have recovered, like Macau, for example. Sorry, I just got a call here. So I hope the Twitter space is still working. But certain areas have recovered, and I track this on a month-by-month basis to see which countries are continually recovering, and how that's impacting the jet fuel demand and then the domestic consumption as well. And I could just go on and on with the amount of data that OAG provides. These are your top 20 country pairs. So which country to which country, Spain to UK being the most popular, Mexico to US being next, Canada to USA being the one after that. So I think Canada to US and Mexico to US, in fact, any of these countries into the US, I want to track what happens to this in June and July, once again, because of the aforementioned vaccination requirement being removed as of May 12th. So I do think there's a big pent-up demand coming in because of that. And a lot of that demand is our nature travel demand, which is a lot of gasoline and diesel burned as the national parks get a lot more traffic. And then along with the graphs itself, they also add their own analysis. So you can read this, you can have your own analysis as to what's happening, but you can also just look at their points that they're trying to make on what is happening, the main points to focus on based on the data itself. This is the same graph that I showed earlier, but by airport. So what is the recovery by airport? You can see Atlanta, again, the busiest airport in the world. Look at Dubai. Dubai is showing about a 30 to 40% increase compared to pre-COVID levels on their seats. Certain airports are showing huge increases. Certain ones are still yet to recover and recovering as we speak. And the final one that I'm going to share for today, RadarBox. So RadarBox essentially tracks flights very similar to OAG, but very much on a customizable level. So here we can see the most active airlines, the busiest airports. We can see the busiest city pairs, the top airports in just the US. We can see the overall historical flight activity. So this is total commercial flights. I shared this graph, of course, at the beginning of the presentation. In the macro portion, we can look at business flights. So the business flights by operator, this, of course, business flights meaning private jets and the busiest airports. And for those who have been talking about private jet use seems to be very high, while we're all getting told to reduce our consumption, you would be correct. Private jet usage is up 30 to 40% compared to 2019. That's a lot of jet fuel being consumed by singular people on these jets, using up a lot of jet fuel while telling other people that we should be reducing consumption. So pretty interesting dynamic going on there. Cargo flights as well, for all the talk that cargo flights are not doing so well. The global the global consumption of goods is not good. It's doing pretty good. The global cargo flights are up 30 to 40% as well compared to pre-COVID. And they're also up roughly 1 to 2% compared to 2022. So far, the overall, some of the softness in diesel demand has more to do with inventory destocking than it has to do with the actual reduction in goods being consumed or sold. We also have military activity that we can track. Pretty funny here when you just look at this. The US Air Force looks to have 6 to 8 times the number of flights in the air as the rest of the top 10 combined. So it's definitely an Air Force that consumes a lot of fuel, and the military flights are up massively. We are up to almost 3x, more than 3x what we were pre-COVID, and even 20 to 30% higher than we were last year. So there's just an overall increase in global flight activity, no matter where you're looking at it. I didn't put helicopters in here, but a helicopter activity is also up 20, 30, 40%. So something is definitely going on in terms of people's want to travel more, go more business travel, more private jets, more cargo, more military activity, a lot of jet fuel being consumed. They also have a live map. So other than all the data for you, they've got a live map. You can track any plane. You can go into it, look at it in extreme detail, where the plane is, what speed it's flying at, where it's going, where it came from. This is our overall the overall platform and where they have tracking. So you can see most of the tracking is around North America and Europe because they have the most flights, but then really good tracking around Japan, China, India, South America as well. This is the overall map. So you can see how many flights are in the air. This is a cloud cover map. This is a precipitation map, and then a turbulence map. So if you're somebody who is very sensitive to turbulence, you can plot your exact flight path on that day and follow it along in real time to know if you're going to have some severe turbulence happening on your flight. So may or may not matter, but all the data is out there for those who care or need to look at it. And that's it on RadarBox. I will share one final one is JP Morgan. So JP Morgan puts out a weekly report on US shale. This is a really, really good report that gives me data week by week on the following things. It gives me production. So lower 48 oil production. I shared this graph on my feed a couple of weeks ago, I want to say. We've got Permian, we've got Eagle Ford, and Bakken. So we've got all this in real time based on pipeline scrapes. This is not a model. This is not what the company is telling us. This is what the actual pipeline is transporting out of the Permian, Eagle Ford, and the Bakken. They also have really good commentary on the quarterly results. So when the quarterlies come out, JP Morgan comes out and they put out a summary of the entire thing. So you can follow along with how the wells are doing. And you learn about a few new things. Like, for example, it says Devon is getting paid by the Department of Energy to fund a refrac program in the Eagle Ford. Did not know this. So things that are extra things for me to track as far as US production moving forward. Okay, they also have the rig count. So the weekly rig count by operator. So who's dropping rigs, who's adding rigs, and in which basin. So Apache, for example, here has dropped 2 rigs in the Delaware, it looks like last week. We also have maps showing all the new wells that have come online. So every single well that comes online in the Permian and the Eagle Ford as well, but I mostly care about the Permian, are shown here by map. It shows all the active drilling rigs in yellow, all the wells, the acreage of each company that they're showing here, and then each well by its IP rates. And then here is the entire graph. So, or the entire table. You can see every single well that came online in the Midland Basin. Again, if you're looking for more information on what all this means, check out my last macro outlook presentation. It has a US shale specific update, and I go through all these tables and all the companies in pretty distinct detail. So either way, what I'm trying to say is I have a source that is giving me every single well that's coming online in the Midland, the Delaware, the Eagle Ford, the Central Basin Platform, and I can see what the trends are, which companies have completely lost the plot, and which companies have still a few decent wells, which companies are moving to longer laterals, which companies are suffering from higher gas rates. You can just make an anecdotal look every week as to how things are going. And when you start to track these things week after week after week, your mind just naturally picks out trends where companies have changed, or something in their mindset has changed, or they just drilled a really bad pad. You can pick things out. Same thing for the Eagle Ford. So this is a bit more clear than this last graph. We can see the IPs, we can see the gas rates, lateral lengths. You can see nobody seems to want to go more than 2 miles in the Eagle Ford. Whereas the Permian here, we see consistently 3-mile long wells, even a 3.5 mile here. ExxonMobil has a 3.5 mile lateral here. But yeah, the Eagle Ford is sticking to its 2-mile platform. And I think I will end it there. So I hope everybody learned a little bit about some of the software and the tools that I use on a day-to-day basis. This is not a complicated thing to do. Yes, there's a lot of data out there. Yes, there's a lot of information. You do have to know what you're looking for or what you're trying to calculate. The main important factors to track and watch, of course, US shale. We have global jet fuel. We have the OPEC exports, and we have the data and the software and the tools that allow us to go and get that information in real time, and sometimes in future time. You know, I mentioned how I can see, or anybody on Vortexa can see the forward-looking cargo or oil tankers that have been scheduled. We can see what the future crude imports looks like. We can definitely see stuff in real time that is not reported on Reuters or Bloomberg or Energy Intelligence or anywhere else. So there's definitely an edge there. And yeah, I just wanted to get that across because I was getting a lot of questions as to what exactly do these platforms show? How are you getting to these conclusions? How are you getting to these inferences? And I think this was a good opportunity to do so. Once again, this is recorded, so it will be on YouTube here in the next couple of hours. And yeah, like I said, next week's presentation, I believe, is going to have to be postponed. I'm going to the Louisiana Energy Conference in New Orleans all week. So I'll be there with a couple of the com guys, as well as some other individuals that have showed interest or have actually are going to be attending based on the attendee list that I saw. So I'll be gone Monday to Friday for that. So may not have time to build the full presentation for Sunday session next week. But if not, we'll push it back to June 11th. No problems, and continue on with that. And then I also have a couple more upcoming. I have an M&A review upcoming, which I'm really, really excited for because I'm going to go through the last 3 years of M&A, every single transaction, material transaction, and go and analyze them down the road. So we'll talk about well productivity on that. We'll talk about, did they make their money back already? We'll talk about what kind of acreage they got, what kind of money they paid. Did they do a good job by paying in shares versus paying in cash or by taking on debt? We'll go and look at some of those over the last 3 years, and some major acquisitions in there. The Cenovus Husky one, the one with 7Gens and Arc Resources, the recently announced Saturn Oil Ridgeback resource. I've been wanting to talk about that for a while, but really wanted to have it in a more structured fashion. So yeah, looking forward to that. And I think I will wrap it up here unless there's any questions. So yeah, I'm surprised we're under 3 hours today. I think people might be spooked on YouTube thinking something weird is going on here. So I can definitely take a couple of questions here if there are any, and then we will let everybody get back to their Sunday here. So so of the things that I discussed, I'll just do a full disclosure here. So I do sign up to Rystad. I do have a subscription to Vortexa. I don't have a subscription to OAG. I have a subscription to RadarBox. That is that one's only $40 a month, so it's not even really a subscription. I do pay for PetroNinja and BOE Intel, and then I do also pay for Shale Profile as well. So or NoviLabs as well. So that's kind of the rough breakdown. The JPM Shale report is available to clients, yes, along with any other sort of bank report. So the only ones that I know are freely available are some of the JP Morgan or some of the Goldman Sachs commentaries that they put out every 6 months or so. Those are really, really good as well. But of course, six months is too long. Like we need to operate on a week-to-week basis, maybe even a day-to-day basis on certain things. So yeah, no, it's great you were able to join as well. So I think that's why I do these sessions and I record them, right? It's Sundays just seem to work for people who can come in and attend live, but also the recordings are always there, and I'm always available over email or by Twitter DM, which gives people the flexibility to kind of do it on their own accord. And I was almost contemplating at one point to possibly do an in-person session, like a macro outlook, but in person, and it's going to be like 45 minutes. So I'm still looking. I've got a couple of opportunities that I'm let's say looking at to do so. So I do look forward to kind of sharing that once something is finalized, because I do think having that in-person connection with a lot of people is definitely important. And we've been doing this over Zoom for what, a year and a half now, which is great because it works. But at the same time, I think making in-person appearances here and there is also good. So this Louisiana Energy Conference will be my first one in my first energy conference in quite a while. So looking forward to it, and always appreciate you joining in to these. PetroNinja Professional or Enterprise. I actually don't know which one I have. I want to say Professional is what I have. Enterprise would be too big for my one-man operation. So yeah, I think Professional is what I have. Does Surge still look good? Nothing has changed in my opinion. I mean, that's the exact same company. Surge is not built for $72 to $74 oil environment. We know that. It's got financial leverage on it, which means it gets torque both ways, upside and downside. I'm investing in the supply demand outlook and the structural outlook that I see. And I invest in companies that are going to perform the best in that structural outlook. There's no company that's going to give you maximum torque and also give you gains at $70 oil or be downside protected to the lowest number. You have to pick the outlook you think is most appropriate or that you want to bet on, and then invest in companies accordingly that are best set up to take advantage of that. So all the companies in my portfolio have massive tax pools. They have the geology to back it up. They have the original oil in place. They all have huge undeveloped land. They have a big bust between the 2P reserves versus what the company trades at. They all have a bit of financial leverage, and they all have maximum torque to higher oil price. So they are higher cost producers. I do not buy royalty companies or very, very low cost producers. Not a fan of the risk reward profile there. And a lot of them trade much more expensive than the higher cost producers. No, I don't have any news on Westcan. I've been kind of tied up with my other private placements. So we participated in Prairie Provident in a major way here that just closed. And then, of course, there's one other placement open right now that we will also be participating in. So I think after that, the focus will move to other of our investments. But right now, doing a lot of due diligence on the private placements that are currently open, along with that rights offering as well. Are there going to be too many LNG projects? Oh, what a great question. Yes, the answer is yes. If the US really thinks they can put out 28 BCF a day, and Canada thinks it can put out 7, 8, 10 BCF, I mean, Canada still could because the Montney is relatively early in its phase, but there is no way the US is going to be exporting 25, 27, 28 BCF per day. We do not have the capacity, the production capacity. Everybody has been fooled by these graphs that just show Permian growing, Appalachia growing, Haynesville growing, Marcellus growing, like without any concern for well productivity degradation or inventory life, or about the takeaway capacity, or about decline rates. All of this declines. This is not a, we're going to build this thing and it's going to produce at this thing forever. It's going to produce this many widgets forever. No, it all declines, and you have to make up for declines, which this issue is going to come to a head in, I want to say August, September, is when the rig count loss and the frac fleet loss will become so painfully obvious, because production will start dropping, not start dropping, production will have dropped by then to an extent that the warning signs will go, hang on a sec, what is happening here? Something has gone seriously wrong. And then people will go and spend the time looking into, oh, well, productivity is actually degrading. Oh, these companies don't have any inventory left, so their production is just going to decline. Oh, the rig count has dropped a lot. So those sorts of realizations are not going to come till that production number actually drops, and then the questions start getting asked with obviously pretty obvious answers. In person with beer, yeah, sure. Yeah, we can have lots of refreshments. I just got to plan out where exactly it's going to be. So I've been wanting to do a Houston and Dallas trip as well for a little bit here. So I'm just kind of going to plan all this out depending on how things go. So yeah, I'll update everybody on my Twitter feed if I do have something in person. But yeah, if anybody else is going to the Louisiana Energy Conference, shoot me a DM and we'll link up over there. I know a few people are already going, and if there's any other conferences too that people who listen to this go to in the US, I would love to know about them. I don't really track them as much because I just don't need to be in that environment anymore. But going to one or two here and there and reconnecting is always great. So yeah, no, it's likely not going to be in San Diego. There's just not enough people here that would be interested or in the energy sector. So likely somewhere else. I'll think about it. Okay, so I think we'll wrap it up with this question. Can you talk can you talk a little bit on PPR? So my thesis on PPR is the exact same as my presentation on PPR that I did on my valuation session or one of the junior company deep dives last year. What changed here? So effectively, what happened was the financing that was on the table, that initially came on the table, was not good. It was not attractive to me. So we worked with the board, we worked with management, we worked with research capital to come up with a different amended raise structure. I'm not going to take credit for all of this. I just suggested a different structure, at which point I would participate in a major way. And lo and behold, the structure was amended where there was a unit offered at 9 cents. The price on the restructuring went up. So the debt conversion price went up 33%, which obviously means less dilution on the restructuring. And the warrant became a full warrant. And this is what's super exciting to me is, okay, I got the share, which is fine. I can buy shares in the open market too, but a 5-year warrant is effectively a 5-year option. And if I can buy a 5-year option on a junior growth company that is still 50% debt, 50% equity, so they have a lot of financial leverage, that has 7 times its current market cap in the, that has 7 times its current share price in 2P reserves per share. They have tax pools all the way until 2071, which means they might be able to monetize these, or they become a very, very attractive buyout target. And I can get a 5-year optionality on that. What better way to play the oil cycle? Like that is exactly what I want. I want a long duration optionality on a junior growth co with a very supportive lender that still has financial leverage and has the reserves and the assets to back it up. That's effectively what I need. And I don't need to worry about tomorrow's oil price. I don't need to worry about next week's oil price. I have a 5-year option now, and I just let it sit there. And it's just a better low risk way of playing this with a huge time premium on it. So I think people who run Black-Scholes models on oil and gas junior company options, I mean, you're more than welcome to do whatever you want, but completely wrong. Black-Scholes models do not properly identify the growth that a junior growth company can have in a structural bull cycle. It's just a reality of the way that options and warrants, I think, should be priced. And that's what got us, White Tundra, and then my sphere of influence to participate in such a major way in that financing. So yeah, I hope that answered your question. If you're looking for more information on the assets themselves, please check out my video from last year. It's the exact same assets. Nothing has changed. Nothing has changed in terms of the tax pools. Nothing has changed in terms of the overall, what I see, a resurgence of old conventional properties. So, other companies like Surge and Baytex and Crescent Point, they had the money. So in 2020, in 2021, in 2022, they went out, they reactivated a lot of their wells, they optimized a lot of their wells, they implemented water floods on a lot of their wells. Companies like Prairie Provident were just stuck in debt. So they had no money to do anything. So even some of their wells that have capital efficiencies as low as $2,000 to $3,000 a flowing barrel, that have like 2-week payouts or 1-month payouts, they couldn't even do those projects. So that gives an indication of what I expect from their production profile here over the next 3, 6, 12 months. Now that they have their money and they're paying about $70 million less a year in interest cost, their entire market cap pre-restructuring was in that $15 to $20 million range. So they're saving half their market cap in interest post restructuring every single year. It's a pretty obvious risk reward scenario from a value investor standpoint. But I will leave it at that. I appreciate everybody's time and your questions. This was more of a different kind of seminar, but I think 2023 is going to be, this is going to be the trend. A lot of the seminars are going to be only pertaining to specific audience. They're not going to be the valuations kind of seminars where anybody can enjoy and learn from it. These are specifically tailored to specific parts of the oil and gas investor. And the next 2 or 3 are the exact same. I do have a junior company deep dives coming up as well. So I'll talk about some of these companies. One in Kurdistan as well that I've been wanting to talk to for quite a while. One is an EOR play. One is the Logan Energy that got spun out from Spartan Delta. And I'm forgetting the 4th one right now, but I've got that. And then after June, I'm going to be taking a little bit of a break. And then I have 3 very, very nice, very enjoyable, I think, seminars coming up that I'm going to put on the schedule here in the next couple of weeks. So I have a reserves session. So studying the reserves of companies a lot more deeply. I have a session on refining and infrastructure value. So how do you value roads? How do you value pipelines? How do you value batteries? How do you value a gas compression plant? So a little bit, sharing a little bit more on that, and we'll do company by company analysis on that as well. And then I have one that I really am looking forward to share, which is a deep dive into every single Canadian oil sands asset. So we will talk about every single SAGD asset. We will talk about every single CSS asset, and we will talk about every single old school bitumen mining asset. We'll talk about the history of the asset, what they produce, how the companies have brought them online, what their effective life is, and then some of the projects that are already approved by the AER, and maybe some of the new projects to watch out for in a structural cycle as it continues on. So really looking forward to that one because it just hits home. I'm not by any means a oil sands expert, but Alberta is oil sands. You know, we can talk about conventional oil all we want, and it makes for a great investment thesis in specific companies. But when it comes to actual physical barrels produced, the Alberta oil sands is really the one. We're producing over 1 billion barrels a year from this. So really fantastic. And thank you everybody else once again for attending, and have a great rest of the weekend. We will catch you at the next one.